Around zero. We still see that. You can see FTSE futures down, now up, but very marginally, very fractionally. DAX futures also, their Euro Stoxx futures just went completely unchanged. So not a lot of movement in terms of futures, not a lot of direction for what we're going to see in the live cash trade. And we'll kick it off with the FTSE as usual. Take a look at the global macro movers screen. The left-hand column is the live cash equity index trade. You can see that the FTSE is up 0.1% right out of the gate, as is the IBEX, both moving up to 0.2 gains. So we do see what looks like a little bit of a risk-on picture then this morning in terms of at least the first two equity indexes that opened up. We should note that investors are selling the yen against the dollar right now, but they're buying gold and they're buying treasuries. The DAX is out, open up 0.2% as well. The CAC also showing gains right at the beginning. So European markets opening just slightly higher. Joining us now is Sharon Bell, Goldman Sachs Senior European Equity Strategist. And Sharon, we're seeing slight gains here. We saw a little bit of gains yesterday on the M&A impetus. Do you think that two-week rout we saw is behind us?
Well, I mean, there's going to be volatility. There always is in the markets. But generally, we are pretty positive on equities, yes. And we've recently upgraded to overweight our equity view over 3 months and 12 months. We think the recent setback was very short term. We think there'll be volatility around the election coming up in the US, obviously, but generally we think versus other asset classes, equities will remain very good value.
Sharon, good morning. What is it that underpins your positive view on stocks then here in Europe over a 12-month horizon? Sure, there might be volatility around the events that you mentioned, but over a longer period, what supports the positive view?
I think, look, there are several things that support it. The big thing, the main thing, obviously, is that you get economic improvement through next year and the second bit of this year. So really what the assumptions we're making is that we get a vaccine at some point. This becomes more widely available in the middle of 2021, that rates stay very, very low, central banks stay extremely supportive, and you see earnings revisions move up. So really earnings improvement, GDP improvement, rates and policy staying very, very easy. All of those things obviously could be curtailed by some political risk in short-term periods, but I think over the medium term, equities still look good value for those reasons.
So what are the differentiators between what we see happening in the US and here, Sharon? Because everyone's going to have, I guess when a vaccine comes out, pretty much, you know, all major Western countries are going to have access to it. When you talk about low rates, that's something that's the same around the world. Do you like European stocks better than US stocks right now?
Not particularly. I think they both, I mean, the US looks more expensive, but then it's always a more expensive market because it has a much bigger weight in tech and higher growth areas. Europe looks cheaper on, say, most ratios, like a PE ratio. It looks particularly cheap right now versus the US compared to history. It's on about a 25% PE discount. That's quite a big discount. So, you know, in a way, Europe does look quite inexpensive, but then Europe's got lots of risks. Brexit-related risk has risen more recently, for example. Inflation is much, much lower in Europe. Growth rates are generally lower in Europe, and there's less in the way of tech companies. But Europe is also big, Germany in particular, a very large exporter, and very geared to global growth. So if global growth does pick up, and markets start getting worried that tech stocks are perhaps a little bit rich in the US, or worried about risks around the US election and tax rates, then I think Europe does look a little bit better from that perspective. Perhaps slightly less risky, but we wouldn't expect a huge amount more return from Europe than the US. We like both markets.
I noticed the ZEW number is about to come out, Sharon, and we're expecting it to be around 70, 69, 70. It's really at an incredibly high level. This is a German business confidence number, and you have recently introduced a long recommendation on the DAX because you're concerned about some other European issues like Brexit. Is Germany in a sweet spot in terms of the European benchmarks?
Yeah, I think Germany is in a bit of a sweet spot. It's interesting because it fits a kind of barbell approach that we have at the moment, which is that we still quite like the tech sector because we think that rates will stay low. And actually, Germany has a very big weight in tech now in the index. 15% of the index is tech. So that's helpful. But also Germany has got a lot of chemicals, industrials, more cyclical companies, and they would benefit if we're right about a vaccine, if we're right the global growth picks up in 2021, all of those things. And as you say, confidence is picking up. A lot of the recent data in Germany has been reasonably good too. And Germany's domestic economy is one of the stronger ones in Europe. So for all those reasons, we do like the DAX.
Where do you look to European corporates, Sharon, to prove that EPS can bounce? I'm just looking at the response we're seeing to the H&M numbers this morning. The stock is up by 10% in this morning's trade after Q3 numbers beat estimates, essentially. But away from the detail, perhaps, of that particular company, worth noting. But where are you looking for European corporates to prove that the EPS can rebound? Because I know that you've talked about how EPS rebound in Europe has been disappointing. Where do you look to European corporates,
I would say
Sharon,
the second quarter result season was better than expected in Europe. It outperformed on average earnings, outperformed by about 8%. It wasn't as good as the US result season though, but it was a better than expected result season. Now, partly that was because earnings have been revised down so much through the year. So partly it's because analysts are already very pessimistic in their numbers. And I think that's kind of where we think we're at. Analysts are very pessimistic already. They're already embedding quite a big decline in earnings for this year. And we think particularly next year, assuming you get a vaccine, rates stay low, economies recover, there is some scope, a little bit of upside in some of those earnings. And in terms of where we're looking for the upside, there's a mixture really. I mean, obviously more cyclical sectors should benefit. Companies exposed to China growth improving. Companies exposed to this global economic cycle pickup should do a little bit better. I think companies generally in Europe will see an improvement next year.
It's interesting. I think you recently introduced a long on the FTSE as well versus UK domestic stocks because the FTSE 100 is much more globally exposed. Obviously, that's the point of it. Is that a smart bet, you think, for Brits who want to try and hedge out Brexit?
It's a tricky one, isn't it? Because obviously FTSE 100 is a star index in the UK. It's the blue chip index, but isn't super exposed to the UK itself. That's probably, if you want just pure UK exposure, you'd probably need either to pick a UK domestic basket like R1, or FTSE 250 is about half of its sales go to the UK. So they're much more UK centric indices. Whereas FTSE 100 is super international, as you say, and related to global growth. And we do quite like the idea of exposure to global growth and some of the commodity-related sectors as well, which dominate the UK index, the FTSE 100. We're looking for global growth to pick up and for commodity prices generally to be okay over this next year. And we do think commodity sectors, they're in the value space that people haven't liked in recent months, do look particularly good value in the index at the moment. And yet you're right, we also don't particularly like UK domestic exposure now. Risks around Brexit have definitely gone up. And we see UK domestic stocks on a similar valuation to FTSE 100. So why not go for those international players?
Sharon, thanks very much. More on that UK call in just a moment. Sharon Bell, Goldman Sachs Senior European Equity Strategist. She stays with us a little bit longer on the programme. Coming up, the ayes have it. Boris Johnson's plan to water down the Brexit divorce deal passes its first hurdle in the Commons. Could there be further hurdles, though, in the lower house and in particular in the upper house? We'll talk about what that means for UK equities next. This is Bloomberg.
Welcome back to the European Open. We are right now 10 minutes into the trading session, and we're looking at kind of a mixed picture. FTSE up about 0.1%, DAX and the CAC down about 0.1%, but then the UK is different from Europe. Let's get into the Bloomberg Business Flash. For that, we go to Laura Wright in London. Laura?
Thank you, Matt. Bayer has settled thousands more US lawsuits over claims its Roundup weed killer causes cancer. It comes after criticism the company was failing to uphold the $11 billion deal it announced in June to resolve most of the litigation. The settlements mark a significant step forward in the case. Citigroup will resume job cuts starting this week. It's joining rivals like Wells Fargo in ending an earlier pledge to pause layoffs during the pandemic. The bank says the reductions will affect less than 1% of its global workforce. With recent hiring, Citi says overall headcount probably won't drop. Fiat Chrysler has agreed to shrink a dividend tied to its merger with PSA Group by 2.6 billion euros. That's to shore up the combined company's finances in the wake of the coronavirus pandemic. The reduction will be partially offset by Fiat shareholders getting a stake in French supplier Forex. That's your Bloomberg Business Flash. Matt, Anna.
Laura, thanks very much. Laura writes in London. Now, the pandemic has upended how many employees work, and rising virus cases have dealt another blow for those those hoping to return to their desks. The shift away from offices is reshaping the economies of our cities too, leaving many centrally located businesses without customers. We sent somebody to investigate. Danny Berger's here with her findings. Danny, just how important are these businesses that are built around our commute into the city daily, I suppose?
Yeah, it's really huge, Anna. We have a lot of businesses that need white-collar workers who go into the office, maybe on their lunch break, go grab a coffee, do some extra shopping, or after work stop and do errands. So it's really widespread. It's everything from gyms, dry cleaners, coffee shops, pubs, you name it. There are just so many businesses in cities that need people in their desks in the offices. And in Europe, about 70% of employees are still working from home as at the end of last month, according to Morgan Stanley. In the US, a PwC survey found as many as 77 people spent some time at home. And look, here are the stats on London specifically, on how many people are in each industry. Services, altogether, the industry employs more than 4 million people in the city. Finance is just 1.2 million. So you can see there's this central business ecosystem that's not just important locally in the local economy, but really the global GDP. It contributes a lot to it. And without it, we're seeing businesses start to struggle, consider shutting down. So it really is crucial.
What are the businesses themselves saying, Danny? I mean, what are they saying in terms of their footfall without everyone in the office?
So I actually spent a greater portion of the past couple days just walking around the city, asking people, what have you seen? Are people coming back? And so what I've heard here in the city of London is that footfall for some of these stores are starting to pick up, but not enough. For example, I spoke to a couple that owns an off license not too far from Bloomberg's offices in the city of London, who said that they are really struggling. They're having issues paying their landlord. Their landlord isn't giving them any sort of rent freeze or any sort of release. They're struggling there, but they were confident that people, especially young people, will start to return to the office. I also spoke to a shoe store. Again, not something you'd think of something that would take a big hit in the pandemic, but no one's going to go buy running shoes on their lunch break. So one of the employees there, the store supervisor of a store called Sweatshop here in London, said that they are suffering. Their main managers aren't sending them more stock because they don't have enough people to sell it to. They also operate a gym. No one's going to the gym anymore. And instead, we're seeing these businesses start to spread out. They're going to the suburbs. They're going to more rural areas. But there needs to be a huge fundamental shift in how these businesses, the central business district, is organized if we don't see people starting to come back to their offices and desks in the cities. Anna?
Yeah, Danny, if in your sector work from home works, then you wonder what it is going to take to persuade people to get back to that daily commute. Danny, thanks very much. Danny Berger joining us there with the latest on these work from home trends. Let's stick with the UK. Boris Johnson's plan to water down the Brexit divorce deal has cleared its first hurdle in Parliament. Senior members of the Prime Minister's own party denounced the move, but the bill passed relatively comfortably by 340 votes to 263. The bigger battle is expected to play out when it reaches the House of Lords in coming weeks. Let's talk about where UK strategy goes then as we approach or as we head towards the end of the year. Sharon Bell, Goldman Sachs senior European equity strategist, is still with us. Sharon, I don't want to write off the rest of the year entirely, but maybe it would be a good idea if we could just hurry up and get to December 31st. I mean, how are you talked about your long FTSE 100 call. How are you approaching that uncertainty then as we get towards the end of the year? And we are so uncertain as to how the trading relationship would shape up across the channel.
I completely agree. Although we've been here before, haven't we, several times? There's been a lot of Brexit uncertainty in the last few years, so we should be pretty used to it. And what typically happens when there is Brexit uncertainty is you see UK domestic companies underperform. You see sterling more volatile and sometimes falling, as we've had in the last week or so. On the news, and you see FTSE 100, which is a more international index with a lot of dollar earnings, and earnings in other currencies do a little bit better. Now, I should say we are ultimately expecting the UK to agree, the UK and the EU to agree on a thin free trade deal, so not to have tariffs between the UK and the EU, or particular non-tariff barriers as well. So we do think they will come up with a deal eventually, and that will be very important for the UK economy and be very helpful, say, FTSE 250 and UK domestic companies. But there's going to be a lot of risk.
That's incredibly optimistic, Sharon, especially considering the state of the relationship right now and the PM's seemingly, the PM's seeming disregard for the law and treaties that he's recently signed. Why do you think the UK and the EU are going to come to such a big no tariff trade deal? And do you mean like now, or do you mean like in a decade?
Well, I hope we're not here in another decade discussing this, although you never know. We think that there will be one before the end of this year. But, that's our base case. And obviously, there's massive risk around that base case. And there's no doubt at all that the actions of the UK government in the last week or so have increased that sort of negative tail risk, I guess, that you don't get a free trade deal agreed. I mean, the reason we think there will be a deal is because it's in both parties' interest to do so. The EU, obviously, big countries like France and Germany trade a lot with the UK. But similarly, obviously, it's hugely in the UK's interest to do a deal as well. So we think it's everyone's interest to do so, but how you get there and the path you get there, clearly it's going to be very, very bumpy.
And Sharon, I mean, there are deals and there are deals. There are free trade agreements and free trade agreements. Is your expectation that we get something fairly thin here that covers very few sectors, or with little detail and detail to be ironed out later? Or how will it be structured, do you think?
Yeah, I agree. I laughed before about being here in 10 years' time, and we may well be here in 10 years' time still talking about the final deals on Brexit. I think that is in some ways quite likely. We do expect a free trade deal, but it to be what we describe as quite thin, just really goods. When we're expecting the UK out of the customs union and out of the single market, and we're not expecting any deals signed on services in the very short term, other than maybe very temporary extensions. We think that it will take a long time to negotiate all the detail of all of this, and that won't be done by the end of this year. But we don't expect the UK to leave with absolutely no deal, a kind of cliff edge, albeit the risks have clearly gone up of that.
Well, and, of course, after the EU signs the deal, they may just months later decide they no longer want to abide by the deal. And that's their prerogative as a sovereign bloc of countries, right? I mean, is it going to be difficult for other countries to trust the UK after this, whether it's seen as a stunt or a negotiating tactic, or whether it's just seen as Parliament doing whatever it likes?
Yeah, I mean that's to be seen. I mean they haven't actually reneged on the withdrawal agreement as yet. So let's see. I mean they're still doing deals with different countries as we go over this next year. But I think it opens up risk, obviously. And this is kind of why we don't particularly like UK domestic companies and exposure to that area at the moment. It's not that we don't think the UK economy will recover. We think it will. But we think there are two big risks here. There's the political risk, which the government have injected. And maybe they've done that for certain negotiation reasons, but undoubtedly that increases risk. And then there's also the short-term economic risk from the furlough scheme ending too.
Yeah, and in terms of the sector, so when you go long FTSE, and you've made this long FTSE 100 call, Sharon, which of the companies or the sectors that you're very interested in? I was looking at a list, and some of them seem to be fairly cyclical, and you even have, I think, civil aerospace in there. You must have a lot of confidence in recovery in that sector.
Yeah, I mean, civil aerospace is a tricky one, isn't it? I mean, I think ultimately we'll get back to the same levels globally of flying that we were at last year, but probably not until 2023, 2024, and probably very different types as well. It's going to be mainly focused in Asia, where there's a growing middle-class population that want to fly. There'll probably be less business travel, etc. So I'm not saying it will be as it was in 2019. Just that eventually we'll get to those levels. It will just take a few more years. And yes, we do have some cyclical exposure. We also like the tech sector, which actually the FTSE 100 really has very little exposure to. But we like commodities, so basic resources and oil, and all those areas are quite cyclical. They will benefit from economic improvement. We like construction and materials as well. Across Europe, we like that, with the idea that you get fiscal spending, and that governments will need that additional infrastructure spending to boost growth as well. And of course, low rates enable it.
Yeah, and of course, absolutely huge there on the FTSE. All right, fascinating to get your calls and your insight, Sharon. Thanks so much for joining us. Sharon Bell, Goldman Sachs Senior European Equity Strategist. She continues the conversation with us, by the way, on Bloomberg Radio at 9 a.m., so you can just tune in for more on London DAB Digital Radio. Up next, we're going to get your movers, including Hennes and Moritz, the clothing retailer, surging after forecasting a return to profit way beyond investor expectations. This is Bloomberg.
Welcome back to the European Market Open. 25 minutes into a trading session here for Europe that's fairly flat, actually. Stock 600 not going anywhere in a hurry. H&M, the biggest gainer, climbing the most since March after third quarter profits beat estimates. Carrefour is down the most in 6 months after this company in retail, of course, in France is placing shares. And Ocado climbs on the back of Q3 numbers. Matt, autos in focus.
Yeah, because Fiat has agreed to reduce the dividend that it's going to pay out tied to its merger with PSA. It's going to shrink it down to 2.9 billion euros from 5.5 billion euros. Faurecia is falling on that same news. The dividend reduction will be partly offset by a stake in PSA's parts-making unit, Faurecia. And then William Hill is climbing after Caesars, which is its partner for sports betting in the U.S., signed a sponsorship deal with ESPN. Caesars is the largest owner of casinos in the U.S., and it also owns a piece of William Hill's casino arm in Welcome back to Bloomberg Markets. This is the European Open. We are 30 minutes into the trading day, and we're looking right now at a mixed picture in terms of the equity indexes. The Stocks Europe 600 index is very little changed right now. It is up 0.02%. That's not very interesting, but it'll start to get interesting if you take a look at the industry groups that are moving by using the group ranked returns screen, GRR. In that case, you can see that retail's a big gainer, H&M key there. Basic resources, travel and leisure are also rising. On the other hand, banks, insurance, financial services are all firmly down, as well as food and beverage, the food and beverage sector. So you do see a real split in terms of the winners and losers here, Anna, and that tells a more interesting story than just looking at the benchmark index.
Yes, which suggested there was nothing to see here. It turns out that there is an interesting story underneath that hood. Matt, let's talk about somewhere else where we find some interesting narrative right now, and that is UK politics. Boris Johnson's plan to water down the Brexit divorce deal has cleared its first hurdle in Parliament. Senior members of the Prime Minister's own party denounced the move, but the bill passed relatively comfortably by 340 votes to 263. The bigger battle is expected to play out when it reaches, later readings and eventually the House of Lords. Joining us now is Tobias Elwood, UK Conservative MP and Defence Committee Chair. Tobias, very good to speak to you. So how surprised were you by the number voting in favour of this yesterday, given we'd seen outspoken criticism of it and many MPs from the Conservative Party saying they wouldn't vote for it, and then it passed pretty easily? For the international audience, tell us how that happened and whether it will continue to have such a smooth path.
Well, good morning. I think you summed it up very well by saying the bigger battle is next week. Don't forget, this is all the insurance policy in case we slide to no deal. We're hoping this won't happen, but if it does happen, you end up going to no deal, we will need to have an internal market that can work. So the absolute majority of the bill, everybody agrees with. The piece we don't is where we might breach international law by overwriting the withdrawal agreement and Northern Ireland Protocol. And that's the piece that I and other members of Parliament, and indeed former members of Parliament as well, now William Hague here, are concerned about it. I'm pleased, though, that we are getting overtures from the government that recognise the concerns that we have, that wants to make sure that were we to go down this route, it would first come to a full vote of the House. I do hope common sense will prevail when this comes back to Parliament for a vote next week.
Are you concerned about longer-term damage, Tobias, to the brand United Kingdom? I mean, if you think about the fact that your prime minister wants to turn around and break an agreement he just signed, you know, anyone could do that with a trade deal that they have with the UK, or people could refuse to make trade deals with the UK or be skeptical of them because of this.
You know, you make such an important point. I mean, negotiations go down to the wire. There's always a ramping up of rhetoric, as we know, when deals are tried to be struck. But ultimately, we cannot ignore treaty obligations. Let's not forget who Britain is, you know, where we've come from. We are one of the founding fathers of modern democracy. I'm sitting in the mother of all parliaments. We came up with the Magna Carta. This is very precious to the British people and shouldn't be challenged. We have a place on the P5 of the UN Security Council. How can we look China or Russia in the eye and ask them to honour international law when we do this? So you raise such an important point. And this is why the majority of us want to support the government, want to get a deal, want to have that backup as well. But let's do it and be able to keep our heads held up high.
Tobias, we heard from Ed Miliband speaking for the Labour Party yesterday, and he was asking the question about why is the joint committee that was set up by the withdrawal agreement not the place to hammer out differences, if they still exist, around the withdrawal agreement? Why is that not being used, and instead this threat to break international law is being used? Is it that makes people think that this is just some sort of hardball tactic?
Well, I think he makes a point, but also there is a timetabling. Don't forget, 1st of Jan, this is when it all begins. To get legislation through the House of Commons and House of Lords now, you have to introduce it this week, and that's what's happened. So that's why you have that backup plan. But he is absolutely right. There is a dispute resolution mechanism, that joint committee, as you say. This is also taking us well away from the final issues on fishing, on state aid, and how you might subsidize industries, which is part of the actual deal of us securing a future relationship with the EU. So I do hope that we will get this bill concluded. It will be amended, and then we can actually look to actually securing a deal, allowing this very painful journey that's taken 4 years since the referendum to conclude.
I want to point out, as an outsider, although I'm sure for insiders as well, it never really made any sense to have a border between Northern Ireland and the rest of the UK. And of course, having a hard border between Northern Ireland and the Republic doesn't make a lot of sense either. There doesn't seem to be a real solution yet, Tobias, to this problem.
And you touch on the absolute dilemma that has made many talks be so paralyzed over the last 4 years. We have a land border in the UK with the EU. Now, if the south of that land border, Ireland, has EU rules and regulations, but you've also got a Northern Ireland agreement that says the trading right across the island of Ireland mustn't be disrupted, then you have a catch-22 situation. So the actual Northern Ireland Protocol and withdrawal agreement then said, okay, we will have some light touch checks and balances in the Irish Sea. And actually, to some extent, they exist anyway, because it's a natural barrier, if you like. So food products and things like that are checked, which is a common sense thing to do. I served in Northern Ireland in part of the British Army. I remember when the border was there and how volatile the security was. We don't want to go back there. We want to absolutely make sure that the economy of the entire island of Ireland is not threatened. But ultimately, we also have to recognize that there are some EU rules that somehow need to be weaved in to the UK understanding as we seek a more independent avenue.
All right, Tobias, great to talk with you from the mother of all parliaments. Tobias Ellwood is a UK Conservative MP and the Defence Committee Chair as well. Up next, do the Germans do it better? We'll debate the country's successes and failures with the veteran author John Kampfner. His latest book explores why Germany is held up as a model for others to emulate. Don't miss this conversation next. This is Bloomberg.
dystopian future we've seen on screen so many times over the years, where people need to travel through space and time to find habitable planets or shrink themselves down to 5 inches tall to combat overpopulation, is starting to seem less and less like a figment of Hollywood's imagination.
The people who are most affected are already our most vulnerable. Climate change is an equity issue.
It's like a hurricane slowly heading towards us, one we've been warned about for decades. For many, it has already reached their shores.
None of us need to be reminded of the stakes of our work to fight climate change. But if we did, we'd simply have to look around and see the vast fires and smoke-filled air here in California.
Are we going to continue to be caught up in the politic of the day, or are we going to make the right decision for environmental justice?
Saying it can't be done, it's too overwhelming, and climate change is not real, or it's just too hard to tackle, so don't even try. I can almost guarantee you that that is spin coming from oil companies and petrochemical companies.
While we've made important progress, we need partnership at all levels of our government and in communities across our entire nation to ensure that we can meet the enormous challenges we face today.
Those are some of the famous names, politicians and activists talking climate change on the first day of the Bloomberg Green Festival. You can catch the week-long event focused on core issues of climate action. Tuesday's speakers include the chief executive of Philips, I'll be speaking to him a little bit later on this afternoon, and also Iberdrola, and the Formula One world champion Nico Rosberg. Staying with the green story, Donald Trump and California state officials have sparred over whether climate change is contributing to the out-of-control wildfires that are currently raging across the west of the United States. Joining us is Bloomberg senior international editor Jody Schneider. Jody, good morning, good afternoon to you. Give us the latest comments then on both sides, from President Trump, from California's perspective. What is the reason for this latest clash of views?
Well, Donald Trump and California state officials were very much at odds on whether climate change is contributing to these wildfires and whether they're worse this year because of climate change or some other factors. The Secretary of California's Natural Resources Agency, Wade Crowfoot, basically told President Trump when he was visiting there that the warming climate is making the state's fires worse. It just is. And that he said that the science is going to be key, that he wants to come up with a plan to try to work with the science to make this less of a problem in the future. And he showed the president things like an 8-page briefing packet that documented rising average temperatures in California. The president instead said, well, it'll start getting cooler. He said there are other reasons that the wildfires are out of control, and he continues to insist that poor forest management is driving this.
Right. Well, science is a very polarizing topic in the U.S., and it's gotten very political as well to talk about the issue of climate change, of course, around a presidential election. Jody, we're going to talk to you a lot more in the run-up to that election. I want to get over right now to talking about the German government. They say the German government says the country's economic recovery has slowed down due to weaker demand in the manufacturing sector. The economy ministry now expects output will not bounce back to pre-crisis levels before early 2022. According to economists surveyed by Bloomberg, German GDP is expected to rise 6.8% in the third quarter. Now, that may sound pessimistic, but Germany is still doing better than pretty much everyone else here. They shut down earlier, they opened up earlier, the lockdown was lighter, and Germans just seem to do it better, certainly when you look at this pandemic. Joining us now to talk about why that is veteran journalist and author John Kampfner, who reported on the fall, I should say, of the wall as a former foreign correspondent in East Berlin. He's been here throughout that 30 years, and his new book, Why Germans Do It Better, is out, in which the country portrayed as a bulwark for decency and stability in today's turbulent world is presented. John, clearly the Germans have handled this crisis better than anyone. Is that the luck of the draw, or has Merkel's government just got something? Have the German people just got something that the peripheral countries don't.
Yeah, good morning, Matt. And just to say, I've actually spent most of my time in London and elsewhere. I'm back in Berlin now, but I've kept across this country a huge amount over these years. And for me, the reason to write this book was also partly to compare and contrast the really strong and cohesive approach that Angela Merkel took with regard to COVID, but also so many other problems and crises in the past, with the pretty much disaster area that the UK has become over the last 4 years, resulting from the Brexit referendum. And yeah, I mean, you can look at coronavirus in two ways. They have a strong and reliable system, which is not only controlled by the center, but the regions have a huge input into that, which make that view a lot easier. But it's deeper than that. The way society is structured, unlike the US with the mudslinging going on between an out-of-control Donald Trump and the Democrats, and in the UK with our clown prime minister, you just have here a sense of consensus building. So you form coalitions, and even where parties disagree on specific policies, there is a sense of coming together, and it just feels to me more grown up, more socially responsible.
John, good morning. So how does that coalition politics, that consensus building, how does that lead to action and not inaction? Because that's always been the objection to that way of doing things in other parts of the world.
Yeah, you're absolutely right. I mean, there is a flip side to every positive has a negative, and vice versa. And Angela Merkel was being criticized a lot before the start of this year, before coronavirus is kind of being beyond her sell-by date, things trundling along, but slowly here. Germany is slow to innovate. Its auto industry was very slow on electrification and got itself mired in corruption and scandal, VW and elsewhere. So there are problems here. And yeah, it does. They have a phrase here which translates as slow but sure. Things do take a while to happen, but you can sort of be cautiously confident that when they do happen, they happen well.
That is mostly the case. I mean, road work and building construction in the U.S. would take a few months or a year. Seems to take absolutely decades here. But I've noticed other problems. The Germans seem to insist that everyone is paid as little as possible, and as a result, there are very few kindergarten places. They don't want people who work as nurses or in healthcare to get paid almost anything, so nobody wants to take care of old folks. I mean, there are a lot of serious problems. In a way, certainly Berlin still must feel a lot like the DDR.
No, I think that's really overstating it, Matt. I mean, yeah, things are certainly, if you're used to London or New York, Berlin does feel quieter. It's definitely, there's a problem here with innovation. The tech sector is growing, startups are growing, but you do get a sense sometimes that as you say, things are slow to happen. Yeah, there are problems with the education system, but show me a country where there isn't. I mean, in the UK, during coronavirus recently, the high school exam system collapsed, and you would never have that in employment. They have a very strong traineeship, apprenticeship scheme here. People get into jobs.
John, I'll jump in. We seem to have a problem with the signal. Yes, Matt, go ahead.
Well, I was just going to say, I'm excited to read the book, and I totally get John's point, because I see in so many ways, having lived in the U.S., having lived in London, having lived in here in Germany, finally having picked this as the place where I want to live, I see in so many ways why the Germans do it better. But the breakup there in the internet signal from his place in Berlin to our place in Berlin is a great example of something, digitalization, where Germany still has to make strides. So,
Absolutely.
you know, everything here is still done with paper. People want to be paid with cash. Nobody takes cards. If you go to the hospital, you need to bring a whole briefcase with a filing cabinet inside it, because, you know, they just haven't switched over yet. So it's a great topic. I can't wait to get a copy of the book, and I hope we can get John back when the internet signal is stronger here in good old Berlin. John Kampfner there with his book, Why Do Germans Do It Better? Coming up, the NASDAQ 100 breaks a two-day slide. Is this the end to the correction some feared would lead to more pain? We'll discuss today's MLive question of the day next. This is Bloomberg.
Welcome back to the European Market Open. We are 53 minutes into a European equity session, which as a whole, in aggregate, isn't going anywhere very fast. But you can see from that interesting divergence between the FTSE 100 and the DAX and the CAC that we do have some movement. Some of the interesting sector differences, I suppose, are then showing up at the index level as well. So the FTSE 100 makes some moves to the upside. Elsewhere, some weakness. Let's get into the markets conversation then with Tomoko Yamazaki from our Markets Live team. Tomoko, good to speak to you. So I wonder what responses you've been receiving to the question of the day. Is the next 10% NASDAQ move going to be higher or lower? I guess a fancy way of asking if the tech sell-off is done.
Right, we're hearing 10% lower, actually, and I am in the camp of 10% lower myself. In fact, my colleagues just reported about how triple leverage ETF that actually tracks the NASDAQ index is seeing record inflows, and that's despite the recent weakness. So to me, that kind of signals that the hype for tech-led rally that we've been seeing needs to cool down a bit more to see any sort of meaningful buy-to-dip opportunity, so to speak.
How about EM stocks, Tomoko? They've had a pretty good run as well. What is your outlook for EM equities, especially ahead of the key FOMC meeting that seems, so instrumental in the moves of emerging markets later this week?
Right. So I would say it's the same for EM stocks, I'm afraid. I mean, call me a bear, but we've seen vaccine hopes to any sort of fiscal and monetary stimulus leading the MXEF up more than 40% from the March low. Now, we're already seeing signs that central banks may be entering a new phase that is pausing for a while, so to speak. So for that, obviously, eyes will be on the Fed later this week. And that very vaccine hope is going to be quite a challenge for EM countries. I saw a report that for some, it may actually even take until end 2024. So the divergence will only become more apparent when it comes to vaccines.
All right, Tomoko, that's all we have time for, but we appreciate you joining us. Thanks so much, Tomoko Yamasaki from the MLive team. You can check out her work and the work of her colleagues by typing MLIVGO on your Bloomberg terminal. Quick look at some of the movers. We showed you earlier that retail was one of the best performing sectors this morning. That's because H&M is one of the biggest gainers, climbing the most since March after third quarter profit beat estimates. Also, Carrefour is down the most in 6 months as it places 25 million shares. That dilutes what you own now, so a reason for the drop. And Ocado climbing after third quarter sales soar. Anna?
Yeah, interesting moves in the auto space as well. Fiat and Faurecia, keep an eye on those. All parts of the same story. William Hill also in focus because of some moves stateside. That's it for the European market open. Surveillance is next. This is Bloomberg.
Boris Johnson's plan to water down the Brexit divorce bill passes its first hurdle in Parliament, but the Prime Minister faces bigger obstacles in the House of Lords. Heated debate. President Trump clashes with California state officials over whether climate change is helping cause wildfires in the region. And the axe falls at Citi. The bank is set to resume job cuts, ending a promise to pause them during the pandemic. Well, good morning, everyone. This is Bloomberg Surveillance. I'm Francine Lacqua here in London. A lot of focus on the markets. A lot of focus, of course, is what's going on with a lot of the companies that we're following and what's going on with monetary policy. Now, overall, if you look at the way that stocks are positioned today, a lot of the focus is on some of the positive news. So the positive news about a vaccine, the positive news also about some of the trials resuming. We did have some Chinese data showing that the Chinese economy is accelerating out of the virus slump, and that's also helping with yuan. Bonds in Spain, Portugal, and France also rising. Yields on German debt pretty much steady, and oil holding near $37 a barrel. Now let's get straight to the Bloomberg First Word News here in London is Leanne Gerrans. Hi, Leanne.
Hi, Francine. The EU says the ball is in China's court to seal a long-sought-after investment deal. Leaders held a video conference yesterday amid ongoing disagreements over human rights. The meeting included German Chancellor Angela Merkel, European Commission Chief Ursula von der Leyen, and Chinese President Xi Jinping. The bloc is stepping up its demand that China open up its economy even more. Now, AstraZeneca's vaccine trials may have restarted here in the UK, but Reuters is reporting they remain on hold over in the US as regulators examine a side effect suffered by a patient. The interruption raises concerns about one of the fastest moving experimental shots being developed. It's seen as likely one of the earliest to reach the market. And today, President Donald Trump will preside over the signing of historic diplomatic deals between Israel and two Gulf states, Bahrain and the United Arab Emirates. But speaking exclusively to Bloomberg, Qatar's assistant foreign minister has ruled out her country following suit. Global news 24 hours a day, on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg. Francine.
Leanne, thanks so much. Now, job cuts are coming for Citigroup employees. The lender joins rivals like Wells Fargo, ending an earlier pledge to pause staff reductions during the coronavirus pandemic. Well, joining us now to discuss all of this is our Danny Berger. Danny, good morning to you. So just how steep can we expect these cuts to be?
Good morning, Francine. So for now, this first round of job cuts we've heard about, it's not too steep. It's just 1% of the total global workforce, which is just over 200,000. And then when you look on a net basis this year, they have hired about 26,000 employees. So we actually won't see a drop in employment when we look again at the net outcome. But of course, it's significant. Anyone losing their job, there's a lot of pain that comes with that, especially in the middle of a recession. And of course, it's significant because, as you mentioned, Francine, before they had pledged they won't do this, saving their employees some concern as the pandemic first kicked off. But Citi has good reason to do this to get their costs under control. For one, this coming quarter, they're expecting their revenue to decline. Sure, they did well in trading. We've seen this throughout the year with the volatility in the market for both FICC trading and equity trading. But you think about the low interest rates, you think about piling loan losses, a consumer that's spending less, and all of that is a recipe to pull back on costs. Not to mention, we also learned yesterday that Citi is possibly facing regulator reprimands over their risk controls, that their infrastructure and control systems were not up to snuff, Francine.
Danny, thank you so much. Our Danny Berger there with the very latest on some of the job cuts. Now, let's get back to the markets. PIMCO co-founder Bill Gross says investors should play defensive as fiscal stimulus in the U.S. fades. Well, Gross spoke in an exclusive interview with Bloomberg from Newport Beach, California.
I think the demographic influence continues. Globalization has actually turned into deglobalization, which is not deflationary but inflationary. So that's been a change outside the pandemic. And of course, the pandemic has not helped globalization. It's actually accelerated deglobalization. So to some extent, yes, the virus is changing things rather.
Bill, any number of things to talk about, but I've got to go to your memo today where you talk about a $6 trillion deficit. We've heard this from other sources. The great economist Claudia Sahm has made clear we need much, much more deficit coverage. What does your world do? What does the bond world do if we get out to 3, 4, 5, and $6 trillion deficits?
Well, the bond world at the moment, is a melding of the Fed and the Treasury. To my way of thinking, this sounds rather derogatory, but the Fed is the dog and the Treasury is wagging it. And to a certain extent, if the Treasury wants money, if they want 4, 5, 6 trillion, then the Fed will provide it through MMT and through purchases, which they've done. Now, do I endorse that? No. Is that a constructive thing down the road? Probably not. Is it inflationary? Probably yes. We'll have to see, but it hasn't been in Japan.
Right.
But to the extent that we've melded fiscal and monetary, and I think rather permanently now, deficits can increase, but gosh, Tom, we're at 100% of GDP already, and it goes to 120, 130, 140, 150, and at some point, as others point out, if the Fed stays out of it or their influence, then inflation is going to come back. And in any case, we've had inflation with financial assets and with commodities, and so it's just come back in another form.
Bill, I remember the day where you recommended the Procter & Gamble dividend and the bond world fell off its collective chair. Now we have permanence of gross financial repression. I'm going to give you great credit for coming up with that concept. Do we have an asset bubble or bubbles plural because we have your financial repression?
Oh, I think so. And we have an asset bubble because interest rates are near zero and negative in many parts of the world. And that, at least to my way of thinking, through dividend discount models and so on, have inflated growth stocks and anything that, have profits far in the future but are growing fast. So yeah, but financial repression, if we want to speak to that, is something that's always been swept under the rug by not only by Powell but by Yellen and Bernanke, et cetera. It's something that can be fixed at a later point because, prior Fed chairpersons have either focused on inflation or focused on, revigorating the economy, and to the extent that that retirees and to the extent that pension funds and savers, so to speak, are being hurt, well, that can just wait. But at some point it can't, and I think we're beginning to see that. I mean, we don't have to talk about Prudential or insurance companies or banks. We can talk about mom and pop on Main Street in Des Moines, Iowa, where they have no more savings and they're not able to earn money on whatever they have left. And the problem year by year is getting increasingly greater, and I think ultimately that becomes the real chink in the armor of this entire financial complex.
Well, that was Bill Gross, PIMCO co-founder, speaking exclusively to Bloomberg. Now, coming up on the program, we'll talk Brexit, the recovery and climate change with Jim O'Neill. He's chair of Chatham House. That's coming up shortly, and this is Bloomberg.
is critically important that the markets stay open in this time, as opposed to trying to take breaks in the middle. I think that that'll just push off the situation a little bit, but actually could create other pent-up issues if you do close the markets.
Economics, finance, politics. This is Bloomberg Surveillance. I'm Francine Lacqua here in London. Now, the EU tells Xi Jinping that China should open its market further. The bloc's representative said the ball is in China's court.
To be done in other important and difficult chapters of the agreement, particularly in two areas. The one is market access, and the other one is sustainable development. We need China to move on these two issues. China has to convince us that it is worth having an investment agreement.
Let's talk trade and the outlook for Europe. Joining us this morning, Alessandro Terzulli. He's chief economist of Italian export credit agency SACE. Thank you so much, Alessandro, for joining us. I know you have also a big report looking at trade, where trade is coming from Italy. But first of all, when you look at China and the EU, how much of this trade relationship will get back on track in the fourth quarter and into next year?
Yeah, good morning and thank you. Well, of course, China is becoming ever more such an important player, and Europe is always trying to play a more important role in getting all the main players back at the multilateral table. It's not something easy. If we look, of course, at the investment agreement we're talking about, the discussions have been ongoing for 6 years. Maybe, this is a time, it could be a good timing, especially if we look at the appointment of the new general director of the WTO to start, players go back to the table and go again to the multilateral approach. This is not only important, of course, for Italy, as Italy is an export-led economy, an important player in the export arena. It's helpful in general for the global world, with the benefit over the medium-long term to the United States and China themselves as well. Relating to the report we just published last week, that was our 14th report on Italian export forecasts. China is playing a major role, not only because it is the most important market of destination, emerging market of destination for our exports, but it is the most important driver of the recovery in our exports we are seeing in the second half of 2020, and especially getting stronger in 2021.
Alessandro, do you see more appetite to become more, less unilateral? If you look at Brexit, if you look at, we don't know what happens with the U.S. elections, of course, but is there an appetite for countries to grow internationally again, or is it just going to be countries being still more inward-looking?
Well, I see opportunities at this stage, but of course you're right when you say that it is not going to be that simple. There is also, opportunities, but there is always some threats. And the elections in the U.S. will be really very important from this point of view. Under Mr. Trump win, we know, of course, what the approach will be, even though we cannot rule out things may change a little bit. Of course, under a democratic rule, the United States could go back to the table. Of course, I'm not saying that in 1 day or 2 months, everyone, all the players will go back to the tables and problems will be solved. But the most important concept here that everybody understands that tariffs, trade war, trade tensions are to the benefit of nobody. They sit again at the table and they rewrite the rules together. This, of course, will require longer time.
Meaning that if we have maybe President Trump for a fourth term, we're going to see more tariffs and more trade tensions because this administration thinks it works. I mean, if you look at the economy of things, Alessandro, do you still see big leaders across G7, countries wanting to impose tariffs because, they think that it works for their country?
Well, actually, my point of view is that tariffs don't work, of course. But and I think that the U.S. administration, when they started at the beginning of 2017, with the threats of tariffs, they knew pretty well that for sure they don't work over the medium long term. I'm quite sure that they knew they don't work either over the short term. But that was a political message they wanted to give under the America First slogan, of course, that they had promised on their campaign. And now, of course, the pandemic hit, the pandemic shock, and then, of course, the American elections are putting a little bit aside the trade tensions. But, I mean, if Trump had to win again, we cannot rule out, of course, that there will be more tensions, even though, of course, the facts are proving that it is not worth, following that approach.
Do you believe, Alessandro, that Italy has a privileged relationship with China compared to other EU countries?
Do you mean Italy?
Italy, yes.
Yeah, well, I don't actually think we really have a privileged relation. Of course, China is really an important market for us, 13 billion euros exports. This is the latest data for 2019. And of course, we also know, I mean, compared to the potential the Chinese market has for us, we are actually lagging a little behind compared with other peers like Germany and France. So maybe what we want to do, it's not the privileged relations. We want to try to catch up a little bit in order to exploit more the potential we have on that market.
Thank you so much for joining us, Alessandro Terzulli, their chief economist at SACE. Now, coming up, we'll also talk oil with Neil Atkinson from the International Energy Agency. We'll talk, of course, about growth and demand. This is Bloomberg. This is Bloomberg Surveillance. I'm Francine Lacroix here in London. Now, uncertainty created by the pandemic is weighing on economic activity and, in turn, is hurting oil demand. The IEA has now lowered expectations for a recovery, as well as its demand estimates for the third and fourth quarter of 2020. Well, this week also marks OPEC's 60th anniversary, formed by 5 countries in the Middle East and South America. Its aim was to shift the balance of power from the U.S. The organization now has 14 member states and controls over 80% of the world's oil reserves. Now, for more on all of this, let's get straight to Neil Atkinson. He's head of Oil Industry and Markets Division at the International Energy Agency. Neil, I could talk to you all day about what OPEC used to be and how they used to be able, to move the price of oil by $10 with one sentence, and now it's no longer the case. But give me a state of the market right now, Neil. When you look at, demand recovery, do you see it gaining momentum in the coming quarters?
Well, I actually think OPEC did a pretty good job of moving the market back in April when they signed the OPEC Plus agreement. But looking at where we are right now, we've said in our report today, the main theme is that the sentiment is weakening. We saw a big rebound in demand after what we call the Black April period, but we're starting to see the demand recovery stalling, partly because we have a resurgence of the COVID-19 pandemic here in Europe, and also we're looking on the crude side. We're looking at reduced buying of crude oil by China. So there are some indicators out there that the market is losing a little bit of momentum. And instead of oil prices for Brent looking upwards from about $45 a barrel, where they were fairly stable for the last couple of months or so, oil prices now seem to be looking more in the downward direction, around $40 and maybe below. So we're in for a tricky time in the next few months.
So what does it mean for OPEC? Do they need to return to deeper supply cuts? They started adding a bit of supply. Was that a mistake?
Well, I wouldn't characterize it as a mistake, because the deal that they put together in April was put together at times of enormous uncertainty, and it was a terrific tribute to them and their convening power to get countries such as Russia and other producers to join them in trying to stabilize the market. It does look as if the increase in production which has taken place in August, which was pre-planned, long-awaited, no surprise to everybody, it does look as if that higher level of production is coming into a market just as demand growth is starting to weaken. And they, of course, wouldn't have anticipated that when they first made the agreement. So we'll wait and see what they do at their meetings in the next few weeks to see if they decide that perhaps an adjustment might be necessary. But that's not something the IEA is recommending. It's just a question of more supply coming into a market that is perhaps weakening, perhaps unexpectedly.
Neil, overall, we heard from Trafigura saying that actually, the market's going to get worse before it gets better. Just to make sure that I understand your assessment, do you agree with that?
Well, as I said, we think the demand recovery is stalling to some extent, and the supply picture, of course, we're seeing a higher supply. And Trafigura are one of the companies that we've read about who are now chartering ships to store oil. So that is a fairly clear indication that it does look as if the market's recovery is slowing. Whether it's getting worse before it gets better, we can sort of play word games here. But it does look as if the recovery is stalling for now, but the recovery will still continue. There's no doubt about it. It's just it's recovering at a slower pace than we'd anticipated.
Neil, when you look at what some of the companies have been saying, is there a danger that oil consumption, even when we recover from the health crisis and recover from COVID-19, just won't be like it was pre-COVID?
Oh, that's a great question, and of course it's an enormous question that everybody's trying to get their heads around. We've written a box in today's report which discusses teleworking, for example, and trying to understand what the long-term impacts might well be for the fact that a lot of people are still working from home, and a lot of people will wish to continue working from home even when normality resumes. So there are a lot of demand patterns out there. Obviously, the crisis in the aviation sector looks as if it's going to continue for longer than we thought. So the issue of whether we may have already reached peak oil demand is a very interesting
Thank
one,
you so
and
much.
we'll be looking at it closely.
Thank you so much, Neil Atkinson there of the IA.
Another day of risk off across the financial markets. We bring you special coverage of all the price action and implications here on Bloomberg Television.
I was actually poor.
No foreplay?
Eat your bag of Lay's with a smile on your face.
If all the diseases have been taken, I'll take a taxi.
Economics, finance, politics. This is Bloomberg Surveillance. I'm Francine Lacqua here in London. Now let's get straight to the Bloomberg First Word News. In London with me is Leanne Gerrans. Hi, Leanne.
Good morning, Francine. JP Morgan has noticed a decline in productivity among staff working from home. So the biggest US bank is now urging more workers to return to offices over the coming weeks. The lender's also concerned staff are missing out on learning opportunities and being able to bounce ideas off each other. Now, Oracle's TikTok deal not only has to pass a US national security review, it also has to win the blessing of President Donald Trump. Treasury Secretary Steven Mnuchin says the government will look over the proposal this week to create a so-called TikTok global. Sources tell us the Oracle bid is not an outright purchase of the business, but an investment in a newly restructured TikTok. And the health of Russian opposition leader Alexei Navalny has improved even further. The New York Times reports a senior German official says Navalny plans to return to Russia as soon as he recovers. French President Emmanuel Macron has backed demands that Moscow answer questions over the poisoning, calling it an assassination attempt. Global news 24 hours a day, on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg. Francine.
Leanne, thank you so much. Now to the UK, and Boris Johnson's plan to water down the Brexit divorce deal has cleared its first hurdle in Parliament. Senior members Members of the Prime Minister's own party denounced the move, but the bill passed relatively comfortably by 340 votes to 263. Now, the bigger battle is expected to play out when it reaches the House of Lords. Well, joining us this morning is Jim O'Neill, chair of Chatham House and former UK Commercial Secretary to the Treasury, also a member of the House of Lords. Jim, thank you so much, as always, for joining us. When you look at how much resistance there will be in the House of Lords of this bill, do you think it will pass?
I would be amazed if it passed. The mathematics is always difficult for the Conservative party in the House of Lords anyhow, just because of the numbers on the Labour and Lib Dem benches, never mind when the cross benches, of which I am one of, go that way. But I think on this particular occasion, as we've seen with some prominent Conservative peers, it's going to be very difficult for this bill to clear the Lords.
Okay, I mean, what is the wider impact of the government trying to break international law?
It kind of states for itself in your question. Britain, many years predating Brexit, going back arguably for much of my and your professional lifetime, has been trying to identify things it can positively contribute to the world. And standing for the accepted rules of international behavior, particularly things agreed by independent legal settings, is one of the things the UK has generally proudly done so well in an increasingly complex world. And so if the UK is now going to portray itself as a country that's prepared to challenge international rules that it's played an active role in creating, that's going to change some perceptions of the UK, along with more persistent problems that relate to our generally weak economic performance and our low productivity rate and so on.
But does it, lose a bit of status, or do you think the UK could actually lose business because of it?
Listen, at the end of the day, as we see with the mean world of business, business is business, and business people, whatever they say, can't resist the attraction of return and always weigh it off versus the risk. But certainly, all else being equal, unless the opportunities created are even bigger, I would imagine it would definitely negatively impact the way people would think about doing business, because countries wouldn't know with the confidence they had before that the rules sitting behind how they were conducting their relationship with the UK were going to be persistently the same. I mean, it's kind of basic stuff. If you look at many credible indices, such as those of the UN or the World Bank, or ones I was involved in creating at Goldman Sachs, many of them often use governance indicators, and the UK often scores middling in many others, but on things like that, it's historically done pretty well. And if this is going to set a perception that the UK is going to now behave differently, I think it's very much a turn for the worse.
Is this, how difficult a moment is this for, first of all, the devolved, the devolution, but also just for the Conservative Party? Does this have, the makings of the thing that will rip the Conservative Party apart?
I mean, I think you've seen in the lead up to last night's debate and votes, and with the apparent abstentions, a pretty clear sign to the Prime Minister that some important Conservative MPs aren't prepared to just seemingly do as the whole of his cabinet does and just go along with whatever is presented. Against that, I rather strongly suspect that this is part of the same reoccurring playback we get with Boris Johnson and his apparent crucial advisor, Dominic Cummings, that they like to challenge the established status quo, particularly when they think it plays well with the voting public. And as you can see in the British newspapers, by and large this morning, this is being presented as taking on a belligerent Brussels. So I think they can get away with it in terms of forcing Brussels to be kinder in negotiations, and maybe that will win, and this will all turn out to be a bit of a storm in the teacup. But if this indeed goes ahead as a bill that succeeds, I think it would create lasting ramifications for quite a lot of issues to do with the UK, including aspects of how the Conservative Party functions, I would guess. And I quickly add, what do I know about the ins and outs of the Conservative Party, or for that matter, anything else?
Well, Jim, you're part of the House of Lords, so you're speaking to people and have a better idea of what's going on than most. But we have a viewer question, actually, and this person's written in saying, most people may just see this as posturing. What are the real dynamics? Do we have, Jim, an understanding of what the end game actually is for the Prime Minister? Does he just want out without WTO rules, or with WTO rules?
No, I don't think I think the posturing that, as I just touched on, is pretty clear that this is an aggressive tactic, and it comes out of the general playbook that won the Prime Minister and the narrow crowd surrounding Dominic Cummings the EU referendum vote in the first place. And they take the way of approaching negotiations to a whole different, non-conventional level. And it's basically designed to shock in the way this is doing, partially, including for the opposition people they're negotiating with to give in. But what's really below it is more to do with state aid and other aspects of what they think they could then do on policy, rather than anything to do with WTO rules. I don't think that's what they're really after. I think it's partly so they can genuinely ensure that there is no problems with Northern Ireland being in the UK. But I think it's more than that. I think it's stuff to do with state aid and slightly bizarrely, given its size of the economy is small, issues to do with fishing as well.
Jim, thanks so much. Jim O'Neill there from Chatham House stays with us. Coming up, what shape will the economic recovery take? Well, we continue the discussion with Jim O'Neill. That's coming up next, and this is Bloomberg. This is Bloomberg Surveillance. I'm Francine Lacqua here in London. Now let's get straight to the Bloomberg Business Flash. Here's Leanne Garrett. Hi, Leanne.
Hi, Francine. Citigroup will resume job cuts starting this week. It's joining rivals like Wells Fargo in ending an earlier pledge to pause layoffs during the pandemic. The bank says the reductions will affect less than 1% of its global workforce. With recent hiring, Citi says overall headcount probably won't drop. Now, Sony has cut its target for PlayStation 5 production this fiscal year by 4 million units. Sources told Bloomberg the move is down to issues over its custom-designed chip. In July, the electronics giant boosted orders in anticipation of high demand over the holiday season, but manufacturing problems mean it can't produce as many consoles as it actually wants. And Bayer has settled thousands more U.S. lawsuits over claims its Roundup weed killer causes cancer. It comes after criticism the company was failing to uphold the $11 billion deal it announced in June to resolve most of the litigation. The settlements mark a significant step forward in this case. And that's your Bloomberg Business Flash. Francine.
Thank you so much, Leanne. Now, AstraZeneca's vaccine trials may have restarted in the UK, but Reuters is reporting they remain on hold in the US as regulators examine a side effect suffered by a patient. Now, the interruption raises concerns about one of the fastest moving experimental shots being developed. It's seen as likely one of the earliest to reach the market. Now, let's get back to, of course, COVID-19 and the impact on the economy with Jim O'Neill. He's chair of Chatham House, former UK commercial secretary to the Treasury. Jim, when you look at the kind of recovery that we're seeing, but also the number of infections rising, is there a danger that we go back into lockdown? Is there a danger that actually all the efforts in the economy will go back to square one?
Hope not. But obviously, it remains ultimately the possibility. I think if you look at what a number of European leaders have said recently, I would interpret that as being a very much a last resort. It's very interesting in France, where daily infection rates are above 10,000 now for quite a few days, that France has resisted that, and Macron seemed to, perhaps to the surprise of some, avoid announcing any new measures generally over the weekend. So I think that's a sign of what is going through the minds of many European countries right now. And on one level, given the colossal scale of economic hit that we saw in the second quarter and until the summer took hold, you can see why. And if somehow some of the treatments have improved and we can reduce the scale of the size of health hits and, of course, loss of life, then until they, I'll put it another way, until they see signs of a major rise in hospitalization rates and loss of life, I think they're going to be very reluctant for good reason, of many of which were articulated in the spring.
So how will the health crisis actually change our economies? We talk, a lot of people are trying to spin it positively, in that it will actually, accelerate technological transformation. It will, advance ESG. But are we going through a decade of misery before we get to these transformations?
So I've got still quite contradictory thoughts. I do find myself, in terms of the economic cycle, being quite a fan of a significant V-shaped recovery. And every economic indicator I've been trained to follow, or virtually all of them, for the past 30 years, are all generally pointing the same way in so many countries. And I think we're going to see a very strong bounce back in the third quarter all over the place and going into the fourth quarter. I'm also still reasonably optimistic about vaccine introduction, which would, if that's true, and I think there's 4 or 5 that could be brought into usage some stage by Q1, in addition to the AZ one, and that would accelerate the recovery even more. And so all of that makes me more optimistic than I still see most people saying. But there are long-lasting questions about the underlying, or the more structural outlook as to, of course, how we're going to pay, who's going to pay. Actually, does it mean much increased inflation risk? And linked to the question that you just asked, can we move to a world where we don't have these colossal sociological economic failures that the market system fails to address until we hit crisis. And I am hopeful that we will learn to manage our health systems permanently better as a result of this mess. But that's simply perhaps me being an optimist rather than, as of yet, seeing any evidence of that.
But Jim, should we worry about debt as long as countries, as long as it's big countries that can afford it? Do we wait worrying about debt for at least 2 to 3 years?
I think I talked to you many weeks ago, Francine. I actually have become an even bigger fan of the idea of nominal GDP targeting as a result of this crisis. I've actually written a couple of pieces about it. And in that sense, I view what the Fed announced at Jackson Hole as a step in that direction. Because in essence, I think our policymakers will be extremely tempted and should be tempted to have a marginally higher inflation rate as the best way of reducing debt to GDP ratios. And I think that is a much more palatable choice than trying to tighten fiscal policy too soon and running a risk of what happened in so many places, particularly in Europe after the 2008 targets. But of course, it's tricky because it might well be that if the supply side of the economies around the world has been hit permanently, there is a risk that inflation could pick up even more than would be desired, and that would be something that we really wouldn't want. So all these issues are going to continue to play out, certainly in the months ahead and possibly the years ahead, and I think it means probably we're in for a lot more volatile macro picture for the next few years than we've had for quite some time.
Jim, thanks so much. Jim O'Neill there from Chatham House stays with us. Now, coming up, a heated exchange. Donald Trump and California state officials clashed over climate's role in wildfires. We'll discuss that next. We'll also discuss working from home. This is Bloomberg.
Climate change is the defining issue of our time, so we've redefined how we cover it. With clear data and rigorous journalism, we rise to the scale of the challenge to reveal the breadth of possibility. We look at stories from every angle to provoke debate, spotlight solutions, and make sense of the greatest crisis of our generation. Bloomberg Green, solutions for a changing climate.
It is critically important that the markets stay open in this time, as opposed to trying to take breaks in the middle. I think that that'll just push off the situation a little bit, but actually could create other pent-up issues if you do close the markets.
The dystopian future we've seen on screen so many times over the years, where people need to travel through space and time to find habitable planets or shrink themselves down to 5 inches tall to combat overpopulation, is starting to seem less and less like a figment of Hollywood's imagination.
The people who are most affected are already our most vulnerable. Climate change is an equity issue.
It's like a hurricane slowly heading towards us, one we've been warned about for decades. For many, it has already reached their shores.
None of us need to be reminded of the stakes of our work to fight climate change. But if we did, we'd simply have to look around and see the vast fires and smoke-filled air here in California.
Are we going to continue to be caught up in the politic of the day, or are we going to make the right decision for environmental justice?
Saying it can't be done, it's too overwhelming, and climate change is not real, or it's just too hard to tackle, so don't even try. I can almost guarantee you that that is spin coming from oil companies and petrochemical companies.
While we've made important progress, we need partnership at all levels of our government and in communities across our entire nation to ensure that we can meet the enormous challenges we face today.
Well, those were some of the voices on the subject of climate change as the Bloomberg Green Festival kicked off this week. Make sure you catch the week-long event. Now, meanwhile, a California environmental official challenged the president on the issue yesterday. Take a listen.
If we ignore that science and sort of put our head in the sand and think it's all about vegetation management, we're not going to succeed together protecting Californians.
Okay, it'll start getting cooler. You just watch.
I wish science agreed with you.
Hey, well, I don't think science knows, actually.
Well, let's talk ESG and climate change with Jim O'Neill, chair of Chatham House and former UK commercial secretary to the Treasury. Jim, overall, if you look at the fires, if you look at climate change in general, are we going to see finance, investing, but also just the general public being much more mindful of what we're doing to our planet?
As you can probably see, I'm shaking my head after seeing that clip. I mean, goodness me. You know, let's link it to where we ended the previous discussion. That shows you the kind of significant changes we still have to make. We need to somehow advance our capitalist system to provide the right incentives to solve societal and actually economic problems. And I'm very pleased to say in that regard that Chatham House continues to devote a major part of its resources and time to being on the forefront about measures to battle the sustainability of the planet, including economic incentives. And we hope to spend a lot of time the next year trying to come up with ideas about to encourage the financial system and many economic actors to see it in their own interest to stop this kind of thing that's coming across your screens right now. It's dreadful.
Dreadful. Jim, we also heard that, you know, a couple of chief executives at banks, including, you know, the chief executive of JP Morgan, is worried that productivity amongst his employees is falling because they're working from home.
Yes, I saw you report that just as I was waiting to come on from Jamie Dimon at JP Morgan. It's very interesting because I generally have a lot of time for what Jamie says about life. But I'm not sure if I agree with that. Obviously, it is true, and at the core of the whole economist theory of agglomeration, and a lot of evidence comes from people mixing with each other. And if we were to permanently lose that, so if people only ever worked in the kind of small office like the one I'm sitting in now and never mixed with other human beings, then that would be ultimately a real problem for creativity. But I think this is why we will probably end up with a lot more flexible working. And in that sense, I would take the opposite of Jamie. Just almost the mathematical fact, if you stop people having to waste so much time commuting long distances into big urban centres 5 days or 6 days a week, and they can still contribute to the same amount of output. By definition, that is boosting productivity, and that might be one of the better things that comes out of the mess we are in.
Thank you so much, Jim O'Neill there from Chatham House. Now, markets are actually up. We'll have plenty more on markets. Bloomberg surveillance continues in the next hour. We look at gold, we look at futures, and of course, we look at Bloomberg Green. Another day of risk off across the financial markets. We bring you special coverage of all the price action and implications here on Bloomberg Television. Boris Johnson's plan to water down the Brexit divorce bill passes its first hurdle in Parliament, but the Prime Minister faces bigger obstacles in the House of Lords. Heated debate, President Trump clashes with California state officials over whether climate change is helping cause wildfires in the region. And the axe falls at Citi. The bank is set to resume job cuts, ending a promise to pause them during the pandemic. Well, good morning, everyone, and welcome to Bloomberg Surveillance. I'm Francine Lacqua in London, Tom Keene in New York. Tom, we'll spend a good amount of time today looking actually at the banks. I know you want to talk about Citigroup. We talk about possible mergers or not in Europe. And then we'll also spend a lot of time talking about Brexit and this bill, actually, that was passed late last night in the House of Commons.
No, I'll let you and others explain it. I know you talked to Lord O'Neill here in the last hour to get the tone from the great Jim O'Neill. But I'll tell you, Francine, I'm really proud of what Surveillance did on this over the recent days on Citigroup. This was a bombshell yesterday. It is being massaged by Citigroup, massaged by everyone. You know what? It's a reprimand from the Federal Reserve System and the Office of Comptroller. That's not news yet, but that's what's speculated.
Yeah, and this is what's getting quite a lot of attention today. Now, later today on Bloomberg, also we'll hear from Ray Dalio, Bridgewater founder and co-chief investment officer, so don't miss that interview. It's at 2:30 p.m. in New York. That's 7:30 p.m. in London. Now let's get straight to the Bloomberg First Word News in New York City. Here's Ritika Gupta. Hi, Ritika.
Morning, Francine. Tom, the West Coast wildfires have now become a campaign issue. President Trump and California state officials sparred over whether climate change is contributing to the blazes. The president insists that poor forest management is the culprit. Democratic candidate Joe Biden called the president a climate arsonist and warned against giving him 4 more years in office. Hurricane Sally slowed slightly overnight in the Gulf of Mexico. It's now been downgraded to a Category 1 hurricane with winds of 90 miles an hour. Sally will make landfall tonight or early tomorrow, but exactly where is difficult to say. Hurricane warnings extend from New Orleans to the Florida Panhandle. There are fears the hurricane will bring a deadly storm surge and flooding. In the UK, Prime Minister Boris Johnson's law-breaking Brexit bill has cleared its first hurdle in the House of Commons. Johnson plans to renege on part of the divorce deal. It's a move that has been denounced by members of his own Conservative Party. They warned it could damage the UK's reputation. And Citigroup will resume job cuts this week after pausing for the pandemic. The bank says the cuts will affect less than 1% of its global workforce. Citi has more than 2,000 employees. It's facing a likely revenue drop. Plus, Citi will probably have to increase its loan loss reserves this quarter. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg. Francine, Tom.
Ritika, thank you so much. Right now on the data, it's a churn of the market, another lift here. I want to mention the VIX in 25.60 with futures up 18. Francine, as you mentioned, this timely interview with Mr. Dalio scheduled for this afternoon, I really want to emphasize that finally the definitive article is out. Catherine Burton has been covering hedge funds for Bloomberg since time began, and she has written a spectacular update on the travails of Bridgewater. And Francine, that will be front and center with Mr. Dalio. It's been a very difficult set of quarters for the gentleman from Long Island.
Yeah, it will be. It'll be interesting to get actually his take on debt. It'll also be interesting to get his take on, euro. If you look at some of the currency strength, I know the ECB has been trying to grapple with euro strength, which we're again seeing today. Overall, Tom, in the markets, we're seeing a bit of a lift to equity markets. And of course, a lot of the focus is also on positive data out of China. That's giving a bit of a lift, not only to renminbi, but giving a lift to the markets because they seem to be getting out of the COVID economic slump maybe a bit quicker than expected. Now, joining us to talk FX, not only renminbi but pound, is Dominic Bunning. He's HSBC Senior FX Strategist. Dominic, great to have you here on the program. Without talking about the politics of Brexit, I don't know what happens to sterling right now, given all of the uncertainty.
Yeah, good morning. Well, look, I think the politics is front and center, clearly, and the market will be very much focusing on whether the latest developments in the UK create more challenges to agreeing some kind of free trade deal or not by the end of the year. But ultimately, the thing with politics is the impact on the currency ultimately comes through the impact on the economics, in our view. And I think what we're seeing in the UK and the way we look at it is that whether this is a deal or a no deal, come the end of this year, whether we get some kind of free trade agreement or not, the barriers to doing trade, the barriers to investment between the UK and Europe will be higher in 2021 than they are right now. And that requires some level of adjustment, in our view, via the currency. So from our perspective, it's not so much will a deal or not be made and how good or bad will that be for sterling. Sterling probably needs to fall regardless due to those fundamental structural changes that we're seeing in the economy.
To what kind of level does it need to fall, Dominic?
Well, I think that then does depend on the nature of the agreement. But I think our base case scenario is that we're going to get some kind of very limited free trade agreement focused on goods, not really on services, not a huge amount on non-tariff barriers. And therefore, our base case is sterling needs to fall down to around 120 versus the dollar. So it's quite a substantial fall that we still have in our view. And I think in some respects, people look at it and say it's a long way. But it was about a week and a half ago, sterling was at 135. And this is a currency that, because of the structure of its balance of payments, because of its inflows and outflows, when it falls hard and fast. And I think that is what the market needs to be aware of and needs to be more concerned about. And if it's a no deal, it could go even further. We've got 110 on a no deal on cable.
Dominic, Tom Keene in New York, good morning to you. I want to congratulate you and David Bloom. You really led the charge on a resilient dollar. Go through the why again. What is the why of a resilient dollar?
Yeah, I mean, I think, Tom, in terms of the dollar view, we've tried to have more of a nuance this year, certainly in the last 4 or 5 months. And I think the dollar should be more resilient versus the euro versus sterling because of really the underlying growth story, the underlying central bank story. So a lot of the focus this year has been the dollar needs to weaken because the Fed's doing lots of QE, or the dollar needs to weaken because US growth is slowing and it's uncertain. Well, actually, if you look at the growth picture in Europe, the growth picture in the UK, it's been worse. If you look at the central bank response from the ECB, from the Bank of England, they're doing more QE than the Fed. So these arguments don't really stack up in terms of the euro and sterling. And I think the rally we've seen in the euro is not justified by the fundamentals. It's not justified by asset price performance. And you're already seeing, obviously, the ECB getting much more uncomfortable with that euro strength. And I think that's really interesting because then when you compare it to some other G10 currencies, Australia and New Zealand, for example, those rallies we think can continue versus the dollar because they do line up much better with the economics. They do line up better with rate differentials with terms of trade and those other factors.
Does renminbi line up with, quote, the economics?
Yeah, I think renminbi does. I mean, if you look at the background in China, the recovery has been obviously sooner and faster than people were expecting. We've seen a big current account surplus. We've seen a rising yield differential. We're seeing bond and equity inflows as China internationalizes. So from the renminbi perspective, we still think dollar renminbi can keep going lower, down to 660 through the course of next year. And that is because that fundamental picture does match up with currency strength in a way that just isn't the case with some of the G10 currencies.
Dominic, when you look at some of what the Chinese consumer has been saying, it seems, they've been enjoying this industrial recovery post-COVID-19. Are we going to see a significantly different Chinese economy in 12 months, 18 months from now?
I think every time we've had effectively a growth slowdown or deeper than that, a recession in the last, since the crisis, and we've had that China-led recovery, it's looked a little bit different each time, The more recent rebounds have not been maybe as infrastructure focused as they were previously, sort of post the previous crisis. And I think that's what we're going to see as well. We're going to start to see changes in the dynamic, moving maybe more towards a consumer-led society, consumer-led economy to some extent. Right now, exports are doing relatively well in China, and that's boosting the current account, and the import story isn't picking up quite as much. But I think when you look at the changes that China's trying to make to its economy, then I think we are going to see a bit of a shift away from some of that previous sense of everything going into infrastructure investment, and maybe a bit more focus on the consumer side over time.
Dominic, thanks so much. Dominic Bunning there of HSBC. He stays with us. Now, coming up on Bloomberg Markets to Close, Ray Dalio, Bridgewater founder and co-chief investment officer. That's at 2:30 p.m. in New York, 7:30 p.m. in London, and this is Bloomberg.
Is that your view? You don't need all the people you have, or you may not need them all in the office?
We believe that when people are together, that's a critical element for innovation. So we do look forward to having people back in the office.
Good morning, everyone. Bloomberg Surveillance, Francine Lacroix and Tom Keener. Catherine Burton out on a definitive article this morning on Ray Dalio. Mr. Dalio will appear with Bloomberg later today. Look for that. And that speaks to the challenges of the moment, the challenges of the pandemic. With us, Dominic Bunning of HSBC. Dominic, in foreign exchange, I saw somebody yesterday in the Zeitgeist say fixed income is so dead. Everybody's going to the Dominic Bunning world because it's so much fun and it's so easy to make alpha. Is that true?
Well, I certainly hope so. I mean, I've always said that we're the place to be. You know, the stories of the bond market vigilantes, and they've been, you know, completely curtailed by central bank buying. And I think FX, you know, is to some extent becoming the new battleground in some respects. And I think you see that, you know, you see that in terms of central banks. We mentioned just before about the euro strength and the ECB's discomfort with that. I think that's something we're going to have to expect more of, because the room to move on rates is so low in terms of loosening policy and loosening financial conditions. And that's really the challenge that the ECB faces. They can't loosen that much through the rate side. And when the euro strengthens, it has a real impact on tighter financial conditions. So, yeah, I think FX is going to be much more in play with rates at the zero bound. And FX is going to be, if anything, more of a dominant force for markets.
I looked at DXY today, the blended big currency index. I looked at Bloomberg DXY, BBDXY, which is all blended in. And then I looked at ADXY. This alphabet soup, folks, is something Dominic Bunning lives. Great. What's the partition now between big currencies and EM currencies, and how do you play that for gain?
Well, I think, you know, it's all very well grouping currencies into different buckets, but I do think there's just room for differentiation across the board. So, look, if you take G10, as we've said, so maybe the more major currencies, look, we think the Aussie and the Kiwi, the Noki and the Stocky, these sorts of currencies can actually do quite well because they have lots of policy flexibility, particularly on the fiscal side. So their growth stories, their growth dynamics should be a little bit stronger than some of the bigger currencies, the euros, the sterlings, and even the dollars. But then if you go into EM, there's similar differentiations, I think, being made. If you look at, places like the renminbi, where we've spoken about the fundamentals looking more resilient, those sorts of places stand out. But if you go to look at Indonesia, India to some extent, South Africa, Turkey, even Brazil, the stories there don't really match up with currency strength. Turkey's a good example. High levels of inflation, low levels of rates, a dollarization story going on domestically. South Africa, massive fiscal debt, massive deficits, downgrades that have happened, but large foreign ownership and a reliance on those foreign inflows. So to me, there's still a lot of differentiation. You still need to be able to say, look, this currency's fundamentals justify why it's strengthening, but these other currencies, well, they look more structurally challenged, and it's going to be hard for them to rally in a sustained way.
Dominic, is there anything in Central or Eastern Europe that looks attractive at the moment?
Well, I think the way that the Eastern European currencies have been performing has been largely a reflection of the euro rally. And we know that story always kind of plays out when you get a euro strength. The likes of the Czech and the HUF and the Polish zloty tend to do quite well. But again, when I look at those individual stories, I'd be a bit more concerned, because these economies are facing much higher levels of inflation with much lower rates. So you've got a big negative rate story in places like Poland and Hungary. And you've also got this shift whereby the policy dynamic has become much less conventional. So both in terms of the communication, in terms of utilizing QE, for example, these are not things that we're normally used to in emerging markets. And therefore, I do, to some extent, worry about the sustainability of those recent rallies. I think, the zloty in particular, that looks quite vulnerable given the central bank stance and given where inflation is, and also the HUF to a lesser degree. Czech, there's maybe a bit more policy stability. But yeah, I think they've benefited from what's happened to the euro. But again, looking at the individual stories, maybe they're not quite as bright.
Great. Thank you so much for all of the insight. Dominic Bunning there, HSBC Senior FX Strategist. Now, make sure you catch also the Bloomberg Green Festival. The week-long event gathers thinkers, scientists, and business practitioners for a virtual event focusing on core issues of climate action. Now, today includes the Philips Chief Executive and the Iberdrola Chairman and Chief Executive. That starts at 8 a.m. in New York. That's 1 p.m. in London. And this is Bloomberg.
We never thought COVID-19 is going to hit us, but now looking back, I don't know how we could cope without this new sector.
Hong Kong is not by itself a big market, but because of the growth GBA, there's huge opportunity. So we're seeing a huge wave of biotech innovation coming in the past few years.
Almost kind of certain that at the very beginning of our journey to pursue the biotech listings, we'll see a lot of the Chinese companies.
This is just the right thing to do at the right time, and it's such a big sector.
We have second product for approval, and now are actively preparing for the commercialization. And we're expecting to have 2 more products to be approval before end of the year. So we have a high confidence that we will meet the expectation.
Some things you see coming, some things you don't. The trick is to be ready for anything. Pablo from Infrastructure Support is working every day to keep essential market data flowing seamlessly. We keep on, so you can keep on.
We explore the trends, investments, and competition of the European ETF industry. Join us on Bloomberg ETF IQ Europe.
This is Bloomberg Surveillance. I'm Rishka Gupta with your latest Bloomberg Business Flash. Sony is cutting its estimated PlayStation 5 production because of problems with chips for the console. Bloomberg's learned the Japanese electronics company is projecting it will make about 11 million units this fiscal year. That's down from 15 million. Sony is expected to reveal launch and pricing plans for the PlayStation 5 tomorrow. For the first time, one of the 4 biggest railroads in the U.S. will be run by a woman. Warren Buffett's railroad BNSF has named Catherine Farmer its new CEO. BNSF is a key profit driver at Berkshire Hathaway. Buffett once referred to it as one of the 2 lead dogs of the conglomerate's non-insurance businesses. Federal regulators may take action against Citigroup over deficiencies in its risk and control functions. The scrutiny sped up the timing of CEO Michael Corbat's announcement that he's stepping down next year. Bloomberg's learned that Corbat wanted fresh leadership because it could take years to resolve the issue. And that is your latest Bloomberg Business Flash. Tom, Francine.
Thank you so much, Ritika. Now, China's economic recovery sped up in August, led by the first growth in retail sales since the pandemic first hit and an acceleration in industrial output. Well, joining us now from Hong Kong is our Bloomberg Chief North Asia correspondent. He's Stephen Engel. Stephen, when you look at the data, first of all, thank you so much for joining us. But when you look at the data, so industrial production is not doing bad, and actually, the consumer spent maybe more than expected. Is this going to be a trend? Are we now on a better footing, or could it reverse quite quickly?
Well, China's definitely on a better footing as far as the tackling of the coronavirus and the opening up of many municipalities, and also the approvals that people need to travel between different provinces. From my friends and associates in China, they're saying life is actually getting pretty much back to normal. You, of course, have had lots of stimulus and lots of efforts by the Chinese government to open up and get commerce going because, of course, at the backdrop of all of this is the tension with the United States. So they really must boost domestic consumption, and that's been a priority for the last decade and a half. And of course, consumption, went down to, very single digits in the early going, if not negative, of the pandemic. So China has opened up. They have contained the virus. I think the number of new cases was 14 or 15 or something like that. Upwards of 30. I've seen two different numbers, and that's a really small number for a large country like China. So I think right now it's fairly sustainable. But the big elephant in the room is, of course, the U.S.-China relationship.
Well, it's a big elephant in the room. I think we can't get by on a Tuesday, Steve Engel, without a talk-tick update from you. So let's do it right now. What did you think of the news flow yesterday on TikTok, and how will Beijing respond to what seems to be an arranged marriage? Witness Mr. Mnuchin's comments yesterday.
Yeah, I mean, this is the big question: is it a hastily arranged shotgun wedding, right? And will it fall apart at the last hour? Beijing still clearly does not necessarily want to see the sale go to, well, the partnership even. Well, I can't even say that for sure, because this arrangement with Oracle is different than what Microsoft was proposing. Clearly, they didn't want the Microsoft outright takeover. But, there's just a few more days, really, until September 20th, until the United States deadline comes to fruition. The Chinese have been fairly silent of late, but they've basically shown their displeasure with a forced sale.
Stephen, overall, what will you be reporting on China in the next couple of weeks? I know there's quite a lot about the economy, even, the fact that maybe they want more oil than we think in terms of oil demand. But then yesterday, that meeting between President Xi and European leaders, seemed to be a bit more standoffish. Is it going to be foreign policy again at the forefront?
Yeah, well, keep in mind as well, the Ministry of Foreign Affairs in China is actually probably one of the lower ministries on the rung of priorities within China. Domestic issues is far more important. That's not to say that domestic issues have not to the forefront on the minds of Xi Jinping. I think one of the biggest issues, at least today in the news flow, is, of course, with Customs Department in the United States issuing this ban on certain products coming out of Xinjiang, ratcheting up more pressure on the Chinese on the trade front. So they're going to ban cotton products, which includes, of course, apparel. The United States gets 30% of its apparel products, T-shirts, pants, everything from China. And Xinjiang, where these alleged human rights abuses have happened in China, is home to 80% of the cotton market of China. So this is potentially a huge deal if you're basically the United States banning apparel, textiles, even hair products, some computer parts that are made there. This is a big manufacturing part of China that also does petrochemicals, tomatoes, and the like. So it's not an outright ban. They withheld from doing that, but it is selective, and yet another front opened up on the trade war.
Stephen Engel, thank you so much. Greatly appreciate it. Really appreciate these updates, particularly Mr. Engel's perspective on the new Prime Minister of Japan, as we heard that yesterday. Coming up in the next hour, if you're part of Global Wall Street, and particularly New York Wall Street, without question, your conversation of the day Mr. Stringer is the comptroller. He has some ideas, like a transaction tax and taxing the rich. This is Bloomberg. Good morning.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
This is Bloomberg Surveillance. I'm Rishka Gupta with the Bloomberg First Word News. President Trump went toe-to-toe with California state officials who say climate change is making those out-of-control wildfires worse. The president disagrees. During a stop in Sacramento, he blamed poor forest management. Joe Biden also weighed in. He accused the president of being a, quote, climate arsonist. Biden said Western states would not be safe from fires as long as the president is in office. President Trump will preside today over the signing of historic diplomatic deals between Israel and 2 Gulf Arab states. The president and his allies hope it will give him a boost ahead of the election. The leaders of Israel, Bahrain, and the United Arab Emirates will sign the agreements at the White House. And the economic recovery in China sped up last month. Retail sales rose 0.5% from a year earlier. That's the first increase since the coronavirus hit early in the year. Meanwhile, China's industrial production rose for the first time in 2020. And in baseball, billionaire investor Steve Cohen has a deal to buy the New York Mets. Cohen reached an agreement with the firm backed by the team's owners, the Wilpon and Katz families. Terms of the deal weren't disclosed. The website Sportico previously reported that Cohen's offer valued the team at $2.4 billion. He already was a minority investor. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishka Gupta. This is Bloomberg. Tom Francine.
Ritika, thanks so much. It is a fact. We like to listen to bankers. We like to listen to the sell side and the buy side on financial services. Those bankers listen to Jonathan Tice. He writes for Bloomberg Intelligence, and he has a report coming out tomorrow which will shock European banking. We're not going to front run the report, but we're certainly going to talk about the depressed book values seen across all of European banking. Jonathan Tice, thrilled to have you on this morning. I want to go to the idea of there is goodwill on a balance sheet. It is an intangible. But if you're trading below book value, the goodwill becomes badwill. What is badwill and why does it matter?
Yes, good morning. Badwill's become very important for the sector. If you look at the European banks, they're trading in aggregate something more than $600 billion below tangible equity at the moment. And what badwill is if you buy an asset significantly below its stated net assets, what you can do is, for example, the ECB wants you to take additional provisions, so boost your coverage ratio. All the restructuring costs, you can wash through that effective gain on acquisition. So we know why these banks are trading here. The market's saying we think bad debt's going to get worse, your cost base is too high, and even sort of perversely, it's a very unfortunate time for the sector, and the outlook is still bleak. But actually, this discount is going to act as a catalyst to accelerate M&A. We've seen Bankia CaixaBank, Intesa UBI. We even saw this sort of UBS Credit Suisse story doing the rounds yesterday. But without a doubt, now is the time, and the share prices are telling you, the ECB is telling you, now is the time for domestic M&A across European banks.
Would you suggest it will be across border or will it be within a country, as in Switzerland discussed yesterday?
At the moment, we've had this conversation over 2 or 3 years, haven't we, Tom? And I mean, it's got to be domestic first. There are several things in the way that would stop a cross-border deal. But I think cross-border at some point, a couple of years out, makes a lot of sense. But they need to get their houses in order domestically. So Germany, Spain, France, Switzerland, a bit of a left field. And definitely capacity for some kind of M&A there, but more boutique-y. I personally am not going to hold my breath on a UBS Credit Suisse deal.
Yeah, which is what we were hearing about yesterday as rumor, Jonathan, in one of the local media reports. I mean, would it even make sense for Credit Suisse and UBS to merge?
Well, certainly. I mean, if you look at the wealth management business, you look at quite a lot of where technology is changing banking, joint investment costs, reducing duplication. There's a lot of synergy, but you look at the difference in size and you think it's an acquisition, it's not a merger, because look at the market caps. And also then you think, well, UBS Credit Suisse is knocking on 2 times Switzerland's GDP. And they had a pretty big problem in 2008 with UBS as it was and the too big to fail concern. So, yes, for all the reasons that M&A in banking is needed, it makes sense. But between these two, when there are so many other combinations and potential, probably less so.
Okay, so Jonathan, just to make sure that I understand, and you have a great report actually coming out tomorrow, so I hope we speak to you also tomorrow once the report is out, but you're expecting, what, a Commerzbank, Deutsche Bank to merge? Are you expecting a big M&A in France to then be able to do cross-border mergers?
Well, I mean, clearly what we are looking at is what's the market sort of implicitly enticing banks to do. So you look at the cheapest banks in Italy, you look at the banks trading at the biggest discounts in Spain, and most investors, the screens are pretty straightforward. So you need the domestic consolidation. So without a shadow of a doubt, Commerzbank, the rumour mill will start again, and they will have spent their whole time running the slide roll about what combinations can we do. Deutsche Bank will almost certainly end up coming full circle and think, well, we need to do something domestically with our legacy Postbank, etc. So clearly we can't speculate on sort of which names will get together. But as I say, if you look at what the market is telling you, and you start in market in each of the different markets, it's pretty straightforward to sort of come up with who's the slightly larger party, where do the synergies come from, where do we really need? For example, Bankia CaixaBank, quite clearly the government is a little concerned about Bankia's balance sheet as we go into the downturn that is coming. Folding that balance sheet into CaixaBank makes an awful lot of sense for an awful lot of reasons, and you can utilise that badwill to increase the provision cover to get a big cushion. So as I say, we're not in a position to sort of say we think this and this will happen, because we don't do that in Bloomberg Intelligence. But we can certainly show you what the market's kind of speculating, and I think in a lot of cases it makes sense.
All right, thank you so much for all of the insight. Our Bloomberg Intelligence Senior Banks Analyst, Jonathan Tice. Now, up next, we speak to the Chief Executive of Edelman. He's Richard Edelman. They have a new report out on whether people are comfortable going back to work. We'll talk working from home next. This is Bloomberg.
Bloomberg Television is reinventing one of the most iconic brands in financial television for a new audience. Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week.
This is Bloomberg Surveillance. Tom and Francine from London and New York. Now, after months of working remotely, companies are encouraging employees to come back to work. But according to a report by Edelman, only half of workers surveyed globally said that they feel office space are safe. And at the same time, JP Morgan has found a dip in productivity levels when staff work from home, particularly on Mondays and Fridays. So to make sense of all of this and how to encourage safely workers to go back to work, let's get straight to Richard Edelman. He's Edelman Chief Executive Officer. Richard, great to have you on the program. I mean, it's amazing when you look even at London, how many people feel comfortable going back to the office, and not compared to a France or an Italy, where I think they have 80% occupancy. How do chief executives get people safely back in the office?
So, Francine, it's a trust issue. And at the moment, in fact, as you said, half the people think that workplace is unsafe. Only 20% say that they're going to be going back anytime between now and Christmas. And it actually has a lot to do with getting to work. Only 8 or 10% of people say they feel good about going on the subway or bus or train. And so if they can't get there, it's really problematic.
I mean, will a vaccine change that? Something that you highlight in the report is that actually people are confused about the virus because there's just too much information, and often it's contradictory.
Well, I think that first place, you have to make sure that employees understand that each employer is going to take 4 or 5 steps at the workplace to change the ecosystem. So less density, wearing masks, making sure that there are few people on the elevator, temperature checks, all those sort of tangibles. But on top of that, we have to make a major effort to get people vaccinated. And the anti-vax data from our study is stunning. Almost half of French, 40% of Americans say we either won't or we're concerned about getting vaccinated. That's a disaster.
Richard, I got one question on this, and we've got to go to other matters at hand. And congratulations on leading the industry in trust, leading all of the Bloomberg world in the study of trust. To me, the trust is childcare. There's a complete failure. I see it every single day. What does your survey say about this desperate need across all income levels, all salaries, on childcare?
So, Tom, you've identified a real sore spot in the system, which is that moms and dads who have little ones are 75% say we're happy to work from home. And we think that our employer is just fine with that. And so they are focused on family correctly, and they have to make sure that their kids are going to be okay, particularly with homeschooling, right? We don't have school systems up and going in many cases. In New York City, for example, I think it's 2 days at school, 3 days at home. So you have to expect, unless we solve that, we're not going to fix the problem.
Richard, I've got to turn to matters prosaic, and that would be, of course, in the banking business, Citigroup. We don't need to talk about a UBS Credit Suisse merger, but with Citigroup, I mean, come on. It's been a managing the PR message since Thursday, I believe it was. And finally, last night, we see the reality of a reprimand by two government agencies. One is the Fed. How do you manage that message to maintain trust with all of the institutional relations that Citigroup has?
So Citi has had reputation challenges for the last decade. And I think, Mike Corbett did a pretty good job of steadying the ship. Now it's to Jane Fraser to take it forward. But if you have a problem, you have to address it head on. You have to show progress. You have to be transparent about the cause and be sure that you have a game plan that shows the best of the bank. And I think, Wells Fargo has finally made the turn with Charlie Scharf, and that shows what's possible, but it took quite a while to get there.
But so Richard, why is there a reluctancy to actually come clean straight away? I mean, in certain instances, it backfires, right? We saw it with Barclays and LIBOR. They were the first ones to come out, and it didn't go so well.
So I think companies make the mistake of believing that personnel change is the solution. And even the CEO can't make the difference without an explanation of problem and creation of a game plan that people can believe in, and particularly the employees. The most trusted people now are your peers. So we have to make sure we talk to our own people, and then they can spread the message within the institution and outwards.
Do banks still have a trust issue, or have they gotten away from the 2008, legacy to actually be an agent of, if not good, of better things because they're lending in the middle of a pandemic?
So the trust scale shows that financial services is still at the bottom of 10 industries. The one that's really zoomed is pharmaceutical, up something like 20 points in our last study. And so, but banks have actually been important in the States, for example, in making sure, JPM in Detroit and other markets really changing the ecosystem of finance.
I look, Richard, at all the work you've done on trust right now. I want you to get out front of the non-Davos that we're going to see this year when you usually release your trust. What's the industry got to do within a pandemic? I mean, what do C-class officers have to do to provide leadership and governance given this horrific pandemic?
Tom, I think in the next months, we have the sort of testing time for business.
I agree, totally.
The reality we actually did a mid-year study on trust and found that government had become the most trusted institution as of May, 12 points over business. And that was a big reverse from January. The key change was, here's government as the big actor, sort of a post-World War II kind of mentality of the only one big enough to deal with this level of problem. Business, though, in this period of return to the workplace and trying to come to a new normal, it's in our hands. And it's in our hands on systemic racism. It's in our hands on COVID. We've got lots of things in which we can prove that we are not only making money for shareholders, but also serving society. That's the key balance that we have to find.
And Richard, are large corporations ready to do that? Are they stepping up, and are they really trying to be the cause for good, or is it just happy talk?
I think Unilever is a great example of one that is. For example, they changed the jingle on the ice cream trucks because they found that it actually had origins in the minstrel days on the 100th anniversary of Good Humor. That's a big deal. And it's not just some sort of performative behavior, it's actually making a change. And I think the smart companies will recognize that they can make money, have products that solve for COVID, but are also responsible on pricing, making sure that people understand the clinical trials, so that we're just not having a vaccine dropped on us and expect people to just magically take it. There's too much history to doubt, and therefore we have got to be sure that the vaccines work, and that also if we have to have a vaccine once and then 28 days later, we should explain this now and not have it be some great mystery.
Richard Edelman, thank you so much. Greatly appreciate it, out with important studies here in September, of course, with Edelman and their Chief Executive Officer. Futures up 22, Dow futures up 158. I'm watching the VIX really stunning over the last 10 days from a 32 level into 25.55. Really something. I haven't done the work yet on where's that key VIX level where we say a return to normal. Not sure what that level is, but we're getting there rapidly. Yields right now flat to a little bit higher. Coming up, there is a Fed meeting. Did you know that? I believe that we know that at Bloomberg. We'll have a special for you tomorrow on the Fed. Julia Coronado will provide wisdom with macro policy perspectives. From London, from New York, this is Bloomberg.
Sense of the real-time action, the 10-year yield tumbling now 11 basis points, so continuing in this knee-jerk risk-off feel.
This is Bloomberg Surveillance. I'm Ritika Gupta with your Bloomberg Business Flash. Bloomberg's learned the Securities and Exchange Commission is examining Nikola over a short seller's fraud allegations. Hindenburg Research says the electric truck maker deceived investors about its business prospects. Nikola has denied the accusations. Uber is joining a bunch of companies that are capitalizing on cheap rates to lower their junk bond interest expense. The ride-hailing service sold $500 million of bonds at an interest rate of 6.25%. That's Uber's lowest rate ever. And that is your latest Bloomberg Business Flash. Tom, Francine.
Ritika, thank you so much. There is so much news flow, just extraordinary for this early part of September, that we've forgotten that there is a Fed meeting tomorrow. Let us catch up rapidly. Julia Coronado with us with macro policy perspectives. Julia, I don't want to talk rates. I don't want to talk foreign exchange. I don't want to talk what kind of sandwich Chairman Powell's going to have before the press conference. I want to talk your wheelhouse. You have been brilliant at gauging aggregate demand, gauging the economy. What kind of economy is this Fed going to manage for?
Well, I think right now there's just huge clouds of uncertainty for them. One, the fiscal package the momentum seems to have evaporated. So they're looking at a recovery where we're still dealing with the pandemic, but we're losing a lot of fiscal support, which once again leaves monetary policy holding the bag. Now, I think it's too soon to draw conclusions for them. I think they're going to kind of, punt a little bit at this meeting and sort of bide their time because they are already doing a lot. But I think they look forward with a little bit of trepidation that the recovery is losing steam earlier than desired.
Yeah, well, what's your statistic on this? I mean, give us some numbers. I mean, let's pretend you're back in the old days of BNP Paribas where Mr. Fillon wants a number every 3 hours from you. What's your number forward on the economy right now?
Well, I think so far, on balance, the news has been decent for them. In fact, when they're going to be revising their forecast, they're likely going to be revising it up to a decline of, say, 5% from 6.5% in June. So I think on balance, that recovery in May and June was stronger than they had expected on the back of that strengthened stimulus. And then we've kind of seen a variety of indicators, including, very importantly, payrolls still moving in the right direction, but the momentum has slowed. And again, it's too early to see that slowing momentum given how deep the hole is that we're climbing out of. So negative 5% is still, the worst performance since the Great Recession. It's not good. So I think that's where they're looking. I mean, there isn't signs of reversal. It's not like we're heading towards a double dip. It doesn't look like yet. But what they were trying to avoid with their early aggressive action was that long slog that we went through after the Great Recession, that slow grinding recovery.
But, Julia, how much, and good morning from London, how much of an advantage is it having this average inflation target for the Fed?
Well, that's a great question, and there's been sort of mixed views, a lot of anticipation about now that they've put that in place, what are they going to do? And I think the reality is that new framework, that average inflation target, that maximum employment mandate, only one-sided instead of worrying when unemployment gets too low, I think that's already been in place. That's underpinned the actions that they took when COVID hit. It underpinned the 3 risk management rate cuts of last year. So I think it's already been in place, and what they've done is really formalized and codified that new thinking. And that new thinking, by the way, Francine, it's not just the Fed, right? We all understand globally that inflation is lower and rates are lower, and that trade-off between unemployment and inflation has changed, and therefore that gives monetary policymakers a different set of tools and more space with interest rates.
Julia, thank you so much. Too short a visit. Julia Coronado with us with macro policy perspectives. And the backdrop here, of course, is this uncertainty on the American economy. Futures up 25, Dow futures up 183. A couple of good days for the market. Futures in the Dow get back above 28,000. 28,056 is the level there. S&P 500 buttressed up against 3,400. We're not quite there as yet. In foreign exchange, Francine mentioning stronger renminbi off economic data And of course, that is managed. That's a stunning statistic to 4 digits, 6.7768 yuan per dollar. That is on a log basis, folks. That's some acceleration in the setting of the yuan within China. We heard from Steve Engel there earlier. Coming up, like Julia Coronado, we're going to look here at what the Fed will do, but the backdrop will be the equity markets. No one better than Jason Trennert of Strategas. This is Bloomberg. Good morning.
This is Bloomberg Best, your weekly review of the most important business news, analysis, and interviews from Bloomberg Television around the world.
Ken Burns, welcome to Bloomberg Big Decisions.
We have always been a mixture of things. We are always stronger for that mixture.
Growth is a way to stay competitive, delight more and more consumers.
Welcome to the Best of Bloomberg Technology. I'm Emily Chang.
They've moved the needle by acknowledging that they have to monitor the content.
What is one word of advice you'll take with you?
Learn how to listen. And that is certainly something that has served me well.
Ankiti, where do you go from here? It's a huge market. It's a huge opportunity. I want to go 100x from here.
Our philosophy is to partner where we can and stand apart when we should.
When everything around us, including the way we work and live, has been interrupted, uninterrupted service is peace of mind. Kimmy from customer support is responding to a 500% increase in daily call volume, no matter what. We keep on, so you can keep on.
This morning, it was not about a dearth of profit. It was not about the breaking of ceiling glass. Michael Corbett will exit Citigroup while they may face reprimand from the Federal Reserve over shoddy risk management. Shares decline. Shareholders shattered, down still 91% since August of 07. It's about, quote, the code, America's data, and your cell phone, Oracle and Friends. They invent the idea of a trusted technology provider. No word on the, quote, algorithm. And from sea to shining sea, it is something out of Mandalorian. The sun sets a fiery orange. Good morning, everyone. Bloomberg surveillance from New York, from London. Francine, I'm advantaged by the sunset where I live, and it was stunning last night, Francine, to see how orange the sun was in New York. And I know the Boston Herald up in Boston commenting that there is an element of the fires from the west now all the way over across the nation. This is a story, Francine, that I'll say has been underplayed on the East Coast. It's visible, but it's not. If these fires were on the East Coast, there'd be no other story. But it is stunning, this deterioration in the western states.
Yeah, it's really stunning, and I was looking at the exchange with you, Tom, from yesterday between the president and people asking him about it, and again, it's just stunning. Tom, what we're focusing here in the UK is really Brexit. Also,
please, an update.
700,000 jobs have been lost since the pandemic, so there are two things. First of all, the government's still intent on breaking international law, so getting out of the withdrawal agreement that they signed. So that's one thing, and then 700,000 jobs being lost in the economy because of the pandemic.
Huge debate, of course, into the Fed meeting tomorrow. We've got a ton of good guests. Jason Trennert coming up here in moments to synthesize these economic times into the equity markets. Right now, your first word news in New York City. Here's Ritika Gupta.
Morning, Tom, Francine. The West Coast wildfires have now become a campaign issue. President Trump and California state officials sparred over whether climate change is contributing to the blazes. The president insists that poor forest management is the culprit. Democratic candidate Joe Biden called the president a climate arsonist and warned against giving him 4 more years in office. Hurricane Sally slowed slightly overnight in the Gulf of Mexico. It's now been downgraded to a Category 1 hurricane with winds of 90 miles an hour. Sally will make landfall tonight or early tomorrow, but exactly where is difficult to say. Hurricane warnings extend from New Orleans to the Florida Panhandle. There are fears the hurricane will bring a deadly storm surge and flooding. In the UK, Prime Minister Boris Johnson's law-breaking Brexit bill has cleared its first hurdle in the House of Commons. Johnson plans to renege on part of the divorce deal. It's a move that has been denounced by members of his own Conservative Party. They warned it could damage the UK's reputation. And Citigroup will resume job cuts this week after pausing for the pandemic. The bank says the cuts will affect less than 1% of its global workforce. Citi has more than 200,000 employees. It's facing a likely revenue drop. Plus, Citi will probably have to increase its loan loss reserves this quarter. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg. Francine, Tom.
Ritika, thank you so much. One of the great cardinal rules of having a band is be sure everybody else in the band is better than you. Jason Trennert has done that great. I want to do a data check right now, and then we're going to get to Trennert about these markets and where we are. Very quickly, futures up 23, FX flat. Francine, what do you see this morning?
Yeah, I'm just looking at euro rising and retailers leading advance amongst European stocks, Tom, and then we saw data showing that China's economic recovery is getting pace, and that's having a bit of an impact on renminbi.
Stronger renminbi this morning, really something interesting there. And, of course, Stephen Engel talking about the stability and even the increase in China. On to Mr. Trennert, and what he has done has been a miracle over the last decade. Everybody around him is better than him. That's a really cool thing. You know Christopher Rohn, who comes on technical analysis, and a guy named Clifton down in Washington. Jason Trennert joins us now from Strategas Research Partners. Jason, are you long the stock market?
I am, but I'm nervous. It's very hard, Tom, to fade a market when M2 growth is growing at 23% year over year, and the Fed has made it pretty clear that they're in the whatever it takes category. And so, as you know, we've written and talked about before this TINA phenomenon. This is TINA on steroids, and there's really not much you can do about it. Not a lot of other alternatives especially for fiduciaries that need to get a certain amount of return. So I'm a somewhat reluctant bull, I guess it would be the best way to put it.
Well, take the compendium of your wonderful team at Strategas and fold it in. You've got economics, you've got technical analysis, you've got the policy mixture as well. It's a soup all of us have to face every day. What do you do then with, say, the tech and everybody else bifurcation, or the domestic international bifurcation? How do you sum that all together?
Well, I think it actually seems to make some sense, because if I could take them, put them all together, the economy clearly is improving. My own opinion is that the best stimulus for the economy is to for the global economy is to fully reopen the economy, and that's obviously largely dependent upon the virus. And so you're probably not going to get the types of growth off the bottom that you normally would during after a recession, and that's why the growth stocks tend to make more sense, because growth is scarce. U.S. obviously is a much more growth-oriented market than a value-oriented market, and that obviously feeds into the idea that you want to be long U.S. stocks, in my opinion, over foreign stocks, particularly European stocks. European stocks are quite cheap, and there will be a snapback towards value, towards Europe, towards some of the sectors that are out of favor. I just don't think that's going to happen until people have more confidence that the virus is behind us and we can really get back to normal from an economic perspective.
But Jason, is this, I mean, Europe has a lot of talk has been that actually Europe has been undervalued, and you see euro strength maybe reflecting that. So are you also expecting euro currency adjustment?
Yeah, listen, I think, Francine, it's a great point. You know, Europe always trades, or almost always trades, at a discount to the U.S. And again, the sector structure of the European markets is much more financials, industrials, energy stocks, those types of sectors that would benefit most. It would strike me, though, too, it goes part and parcel. I tend to think it's hard to get really bullish on the dollar given our twin deficits. By the same token, it is a relative game, and I would say, at least as far as capital flows are concerned, I wouldn't expect the euro to get a lot stronger until, again, the global economy gets a bit stronger, or we get the virus behind us.
Jason, I mean, so all of the premise of your forecasts on not going back to second lockdown, or is it like a stop and start kind of economy that you're going to see across the world?
It's more of the stop and start, Francine. I mean, I think, frankly, if it's a second lockdown, I'm not sure there's going to be that many places to hide, but frankly, the growth orientation will continue, I would argue, even more. That whatever gains that you've seen in the value-oriented sectors, the cyclical-oriented sectors, would move backwards, and it's largely, again, because there's a dearth of growth, of earnings growth, and people are willing to pay for growth almost at any price when the Fed funds rate is zero, and the Fed's balance sheet the assets on the Fed's balance sheet are now $7 trillion. So I think, I'm praying for at least a stop. Frankly, I'm praying for a vaccine, like we all are, like this evening. The stop and start, I would say, is probably the more likely scenario for investors. I think a full lockdown, I think there's more discussion about the cost-benefit analysis of doing that, because countries like Sweden have done things a bit differently. So I'm quite skeptical you'll have another full lockdown, but the most likely scenario probably is a little bit more of a stop and a start. And that still gives a bid to technology and some of the stocks that are already quite expensive.
Jason, does the math work anymore? I'm supposed to take yield, flip the reciprocal, and it's going to give me a ratio. None of that works. We had 80 billion plus yesterday in M&A. I think some of it based off math, but maybe not. We've got the silliness of Oracle and Toctic. Great. Is the math working right now, Jason, or is everybody just flying by the seat of their pants?
I think it's more the latter, Tom. I think it's much more in the by the seat of your pants category. I mean, anyone who has a CFA or an MBA or knows anything about discounted cash flow analysis, especially when it comes to some of the tech stocks, it's virtually impossible to make the numbers work. I mean, and I understand that these are exceptional companies that do exceptional things, that are benefiting from exceptional times. But still, you know, there are limits, and you have companies that are trading at 80 and 100 times sales. You know, it's hard to make money as a long-term investor. I would argue it's pretty hard to make money when you're paying that on your initial investment. And so right now, liquidity is, in my opinion, is the single most important driving factor in the economy.
Let's come back with Jason Trenner, a strategic researcher. Much to talk about here. Maybe we'll focus on the Fed a little more there. That meeting has really crept up. I can't think of any news flow where I've more ignored the Fed one day ahead than I am right now. Futures up at 23. Our Catherine Burton this morning with a scathing summary of Bridgewater Associates and their recent track record. This afternoon at 2:30, Ray Dalio speaks. This is Bloomberg.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Hi, I'm David Weston. Bloomberg Television is reinventing one of the most iconic brands in financial television for a new audience. Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week.
What our customers are telling us is they're learning how to cook again, they're enjoying cooking, and they're enjoying cooking as a family. All of those things are things that we think will be trends that will happen even when we get through COVID. With our associates there serving our customers, we just think those things together will be really important.
This is Bloomberg Surveillance. Tom and Francine from London and New York. It has been rumored that Tom even cooks. I even heard, Tom, that you actually have a good bolognese sauce. So
I can't
the trend
keep
is
up.
continuing.
Abramowitz is lights out. Abramowitz starts in Friday evening, and it reportedly goes. She watches Arsenal on Saturday and Sunday, but Abramowitz, I can't keep up, Francine. And may I full disclosure, folks, and this is documented out on Instagram. Jason Trenner mentioned it to me the other day. Nobody makes a birthday cake like Miss Lacroix. No one. Francine, where did you learn to put icing on a cake like you do?
Tom, I was meant to go to art school. I didn't go to art school. I now make birthday cakes once a year for a child.
Great.
And that's it. Let's talk about the markets. Let's get straight back to Jason Trennert. He's at Stratagas Research Partners Chairman. Jason, when you look at some of the levels that we've tested, certainly in equities, how much volatility are you expecting during the U.S. election period? So either straight before or straight after.
Yeah, listen, I think, Francine, the differences in the candidates, I think, is so stark. And I mean, of course, it almost sounds cliche because every 4 years, people like myself will say that this is the most consequential election, and the candidates will say that. But this one, I would say, from an investment point of view, I truly believe the differences between the two candidates are very stark, particularly as it relates to taxes, energy policy, and environmental policy. And so I would suspect that there's going to be more volatility going into the election. And I think there's also, more skepticism among our clients or institutional clients who with regard to the polls and what they're telling us. A month ago, we did a survey of about 800 institutional clients. A month ago, 39% of our clients thought that Donald Trump would win. That was in August. We just did the survey last week with my colleague Ryan Grabinsky. It was 57% for Donald Trump. So pretty remarkable spread in just 1 month of a large survey. And I have a feeling you're going to see more of that with, I guess, 50 days to go. And I would imagine it'll get, unfortunately, a little uglier as we get closer to Election Day. And that should probably give investors some pause.
But Jason, what exactly is priced into the markets right now? Is it a Democratic win, or is it a second-term Trump?
Francine, I think it's mostly what's priced in is gridlock. Okay, what I do not think is priced in is a Dem sweep, and I think because I think the market would be lower. Personally, I think it would be hard for me to see that to be. I don't want to offend anyone's politics, but it would be hard to see a Dem sweep being a particularly positive development for the markets, and we could discuss whether it's good for society or what have you. But for the markets themselves, it appears to me that people are betting on the idea that it's going to be tough to get any sort of big types of legislation done, and which is not the worst thing. I would argue. I think so. That's my best guess. I think people are going with kind of what the consensus is, which is that Vice President Biden will win. But the Republicans will hold on to the Senate. That seems to be what's being